increasing rates 4 times this year. That's going to be part of the story of rate for net interest income, and volume, to Lisa's point, is still important with loan activity. That loan to deposit ratio is probably still at a 10-year low, and that's why the management called the narrative for the first quarter in 22 on perhaps what does 50 basis points do for net interest income. You'll hear that from Bank of America next week. But if any of these banks talk up net interest income, they have to calibrate for every rise of 25 or 50 basis points. What could they bring to the bottom line?
Ken Leon, as a general statement, looking at J.P. Morgan and 265,000 employees, are they adding employees, or is it an expense regime, as Sonali Basak alluded to, where they're going to keep the chosen few and jettison others?
So, Tom, we've had this conversation for years, and I think what's important is the mix of the employees. What percentage of their employees are being hired, and the size related to technology. Technology plays an enormous part in not only the traditional banking, but also where banking is going. I think for Goldman Sachs, it's 40% of their total employees is technology. JP Morgan, that number has risen significantly versus where we were 5 or 10 years ago.
What's your sense of why loans aren't increasing more and when we could start to see a shift?
It really gets, I go back to the Fed. I like looking at personal savings rate and looking at household debt. The personal savings rate just got back to the normalized historic levels of 7% back in November. They were as high as 18%. The one thing interesting here, though, Lisa, is whether the consumer has changed. It's kind of like a 9/11 or the financial crisis. Did the pandemic make consumers more conservative, not willing really to be spending crazy on their credit cards, and maybe trying to save up to buy a house, which are so expensive? So it's the behavior issue that we won't know maybe for another 4 quarters or so.
Supply chains are part of this story as well, and that's what's fascinating about getting some of these numbers from these banks. You get the commentary from the CEO as well, Jamie Dimon, saying that we've benefited from elevated capital markets activity, that we saw a pickup in lending activity. But this headline here, Sonali, got my attention. The lack of vehicle supply slowed originations. Have you got any insight there into how the supply chain story has weighed on some of the demand for loans at some of these banks?
Yeah, it's interesting because on one hand, it's a consumer issue, and on the other hand, it's a business issue as well. There is this sense early into this year that banks will, bank customers, the biggest clients, will continue to invest, do M&A, take out leverage loans, really engage investors. But if supply chains remain such an issue and higher interest rates start to become more of a scare, then you start to have issues with that kind of thinking, and then you wonder if that 19% return on tangible equity can keep its pace. Guys, you were asking one more thing a little earlier that's worth noting. JP Morgan's headcount and its cost tied to its employees rose more than any other cost. So JP Morgan, like every other business in the world right now, is experiencing that wage inflation while also adding more employees to stay competitive.
You get the feeling, Sonali, we'll see a lot of that through this morning, and we'll see a lot of that through next week and through this earnings season as well. Sonali, just quickly, JP Morgan down about 1.33%. Wells Fargo breaking the rules. They were meant to wait and come out a little bit later. They came out this morning. What's the top line?
Yeah, the top line here is that they have to keep their costs in line, and that idea of remember, Wells Fargo has really kept up in the stock market, so Charlie Scharf has to give investors something to bite on in terms of controlling expenses while growing loans in a stiff regulatory environment that still exists for that bank.
And they got it, 57 in the pre-market. That stock up another 1.8%. That stock year to date is absolutely flying. So as we wrap things up through the next hour, we should get Citi, Tom, a little bit later this morning, and then we'll put this all together and look ahead to Morgan Stanley, look ahead to Goldman Sachs, but JP Morgan largely in line this morning, Tom, from what I can see on my screen.
Yeah, it's going to be interesting to see. Each bank has a different story, and that goes to the European banks as well. And, of course, part of this is the regional banks. As Ken Leon mentioned, the competition out there with a 5-year perspective is extraordinary. John, I'm going to go back to buried in the PowerPoint, mobile activity up 11% at JP Morgan. Technology is the future.
Lisa, final word?
Technology is the future, but how do you compete with fintech that has a lower overhead at a time when deposits are climbing so much and people are not borrowing as much? What is the trajectory of people actually starting to take out money on their credit cards?
Into the next hour, waiting for Citi. We'll get reaction from Shanali Basak and Ken Leon. They'll be staying close to us. Equity futures essentially unchanged. JP Morgan down about 1.4% after a really decent run year to date. This is Bloomberg.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Earnings are going to have to drive the market here.
And valuation support is not particularly good in some segments.
A lot of froth, a lot of money has gone out of some of the more speculative parts of the market.
This is an opportunistic stock picker's market, but you have to do your homework.
This rally this year is going to be unlike last year. It's going to be volatile.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Earnings season gearing up from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market down a single point on the S&P. JP Morgan numbers, Tom, out just 10 minutes ago.
10 minutes ago, and a good, I think, opening salvo of what we're going to see. You mentioned Morgan Stanley and Goldman Sachs, I believe, into next week. And, John, all I could think about in the break as we go to this new hour was Benjamin S. Bernanke saying the integrity and crisis of the financial system is the be-all and end-all. That's a lesson from the Depression. And Jerome Powell and many others delivered in spades in this natural disaster, a banking system that was resilient and prospered. The big question is, now what?
The health of these companies, Tom, the outlook from these companies reflected in the reserve release. Things are better, much better than people anticipated, helped out by the policy story the last couple of years. But things are getting more expensive. And that's why we said repeatedly this morning, it's not just about the numbers as a business, it's about the numbers as an employer. Expenses up, Tom, up 11%. They attribute that at JP Morgan to higher compensation. You're going to see that line repeatedly through earnings season.
And Top Live today led with this, our true experts at Bloomberg on banking analysis. And John, I love what they say. It's a war of talent. And we're going to see that now, and not only now, but into the 2022. We're going to see how that plays out. I thought Shanali was quite eloquent on that.
Well, that's it, Tom. Lisa, maybe things are just getting started. Maybe this is just the beginning.
Maybe. Here's the issue, right? Where's the growth coming from? If you can't get those loans up, if you can't necessarily expand and extend credit for a valuable price, where are you going to get that growth to overcompensate for that higher pay?
JP Morgan in the pre-market right now, down about 2.4%. The rest of the market doing okay. Equity futures unchanged. Let's whip through the price action on the NASDAQ. We're down about 15, negative 0.1%. What a morning we've got lined up for you. Lisa's going to run you through that in just a moment. Up 3 or 4 basis points on 10s now at 173.80. Euro dollar unchanged, but we hold on. We stick to that 114 handle. Lisa, euro dollar 114.52.
Yeah, it's going to be a busy morning. It already has been a busy morning. We've already gotten JP Morgan. We've already gotten Wells Fargo, Citigroup on tap for 8 a.m. Very much focused, John, as you say, on the compensation costs. How much are costs rising with this war for talent? But also, how much loan growth is there at a time when deposits are still climbing? We were talking about people really eating into their savings accounts. Are they? Because the deposit rate is actually growing quite a bit. At 8:30 a.m. amid all of this, we get U.S. retail sales, and again, the focus is on cost, and this is a different kind of cost, which is inflation. How much is the 7% year-over-year increase in consumer prices would actually boost retail sales, which are delivered at a nominal level, rather than the actual demand, which is being crimped on the edges, at least by peripheral data, by consumers who are a little bit reluctant to spend so much more, buy so much more, since they are spending more on their staples. And then at 10 a.m., we get the U.S. January University of Michigan Sentiment Survey. How much does this determine people's view on inflation's effect on consumer demand, on consumer sentiment, given the fact that we have seen kind of bifurcated surveys come out to indicate that sentiment maybe isn't falling quite as much, John?
Lisa, thank you. We are going to be drowning in the earnings through today, through this morning, and through the next couple of weeks as well. Tom Keene, you're very keen to stay on top of the data. Retail sales at 8:30.
Yeah, retail sales at 8:30, and there's a whole other story here, including the dash of Brent crude to 86 as well. John, I want to talk about what's been ignored this week, and this goes into the fine broadcast, the real yield. Folks, you'll be seeing this, I believe, this afternoon if Farrow's calendar frees up. And that is, John, this has been a week of curve flattening. Overnight, we went under 80 basis points on 2's10 spread. And I think a real untold story this week has been the ebb here, gentle ebb, but back down we go to a flatter yield curve.
You know, people are writing in, Tom, they'd like you to make a guest appearance on real yield.
It's in the middle, later. You know, I'll do it from, you know, me and Vetville and Kennel Feet, you know.
Yeah, sure. Mandy Zhu joining us now, Chief Equity Derivative Strategist at Credit Suisse. Mandy, on the one side, there's this big talk about embracing the banks, the energy names. The banks have done tremendously well year to date. Tech's had some problems, some trouble. Mandy, you say buy the dip in tech. Why?
I think there's a consensus narrative that higher rates is bad for tech. Empirically, we don't find that to be the case at all. So, you know, whether you're looking at the front end of the yield curve or the back end, right? So let's take the front end. When the Fed hikes rates, actually over the past 4 hiking cycles, tech has been the best performing sector in 3 of the 4. So we don't find empirically that when the Fed tightens, that tech does not do well. And then if you look at the back end of the curve, when the 10 yield surges, which it did at the beginning of this year, when it does surge, like say 30 bips or more in a month, in the near term, it is a headwind for tech. So on average, tech is down about half the time when that happens. But if you look forward 6 months to a year, tech on average is up double digits and up 90+% of the time. So overall, fundamentally, we're still constructive on the sector, and we don't think higher rates is going to be what derails the tech rally.
Mandy, love your note, and it really fits into what John Gollub's talking about as well. Okay, we've got the cross moments. We can talk kurtosis. We can talk all the rest of it. You know what, Mandy? As you say in your note, it's just about the ability to have revenue growth and to generate profit. How do you dovetail your world into the less mathy world of John Gollub?
I think it dovetails quite well. To your point about profits and revenue, we do, make a distinction when we talk about tech. We do think, big tech with a high quality free cash flow generators are going to do quite well in a higher rate environment. But obviously, there is a more speculative segment of the market, right? So the so-called non-profitable tech, we do think that segment of the market is more susceptible to tighter monetary conditions. But the good quality, the big tech companies should do fine in a higher rates environment.
Mandy, this is a broad question that gets a very different response from everyone I ask it to, which is, what are we pricing in right now in equities with respect to monetary policy at a time when bonds are sending some mixed signals about the rate hiking situation?
Yes, sure. So, there has been a very notable divergence in the volatility market between rates and equities, right? So, rate volatility has been rising for the past 6+ months and is currently, at a 1-year high. Whereas if you look at equity volatility, generally speaking, it's still pretty muted. So I get a lot of questions about, what's driving that. I do think, part of what's driving the volatility in the rates market is this fear of a policy mistake, right? The Fed over tightening, and that's why you're seeing, for example, like the yield curve flatten quite notably, as you mentioned at the beginning of the broadcast. Whereas in the equity market, I would say, investors are generally more sanguine about that possibility. And in terms of what is priced into the market, I think right now people are expecting about 4 rate hikes, with the first rate hike coming in March.
Mandy, it has been far too long. I always enjoy catching up with you. Mandy Zhu there of Credit Suisse. Thank you very much. We've had the backward look from JP Morgan. Now we've got the forward look from JP Morgan. Looking 12 months out. We can get the outlook now with Shonali Basak. Hey, Shonali.
It's really interesting to see what JP Morgan is looking at in the future. Some of the risks include lack of a steeper yield curve here and some of the credit card trends that we've seen from consumers already. The idea of them continuing to pay down balances versus take more debt on and more interest-bearing accounts. Listen, the net interest income outlook is probably the most interesting here, which is $50 billion this year expected of net interest income. Now, this is not necessarily including all of the investment bank. This is a lot of assumptions using the consumer business alone. That includes credit card balances revolving to normal 2019 levels. But what's really going to be the indicator here is if that investment banking debt also picks up meaningfully, because that $50 billion estimate they've given us compares with $52 billion that we have seen, almost $53 billion that we've seen this year. So there's a lot of room for error here.
You said 35% growth in marketing. Is this completely to just compete with fintech?
Well, it's interesting because JP Morgan, cards, wealth, I mean, they have been playing offense here. And if you look at the acquisitions they've made, it's things like the infatuation. It's things to make their businesses for consumers more attractive. So on one hand, yes, to compete with fintech, but also just to compete in the credit card business and the wealth businesses that are ever more competitive. That is 20% growth in tech investments for JP Morgan, 35% growth in marketing, which is an even bigger number. And there will be some increase this year on compensation expenses, though not as severe as those two other items.
Shonali, wonderful. As always, looking forward to your coverage through this morning and into next week on these names as well. Lisa, you mentioned fintech. Let's talk about where the competition is coming from. Buy now, pay later. I mean, some real competition coming from that, just in terms of consumer spending. I went on Mr. Porter the other day. If you've not been on Mr. Porter before, don't. It's addictive and highly expensive. And at the top, Lisa, it says up to $15,000. Up to $15,000 that you could borrow. Buy now, pay later. That's the kind of money on offer at some of these stores now.
Yeah, and check out what some of the rates are on that money, and then check that out with some of the traditional credit card fees, and then you start to understand the competition. This really does crimp how much interest some of these banks can charge on their credit cards at a time when they're increasing their marketing costs around cards. And this is leading to a 35% growth in their marketing costs.
Tom, that is where some of the competition is coming from the credit card business.
It is, John. I'm looking at the 2022 presentation, John, and this is a bank that's going to spend a ton of money on technology. They've got tech and tech adjacent up 25%. And I wonder, John, if they do this, I mean, they make clear they want to do organic revenue growth. Organic growth. Diamond says that's a top priority. Okay, great. Do they do it themselves, or do they acquire that modern financial tech to bring it in and almost to contain it?
TK, there's been talk of an acquisition for a long, long time over at JP Morgan. They've gone in a different direction to, say, Morgan Stanley and Mr. Gorman, as we've talked about a million times. Do you think this is the year?
I don't know. That's a really important question, John. We'd only get that answer at the Davos JP Morgan party. We're not going to get that this year.
We're not going to have that party this year.
Yeah.
In the summer, we might, Tom. In the summer, we might. Tom Keene, Lisa Bramett and Jonathan Ferro. Futures down 0.2 on the S&P. We're down 40 on the NASDAQ 100, down 0.25%. From New York City for our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. More signals that the Fed is set to raise interest rates in the coming months. President Biden's pick for the vice chair of the central bank, Lael Brainard, told a Senate confirmation hearing rates could be increased as early as March. Meanwhile, Fed Governor Christopher Waller told Bloomberg TV that 3 rate hikes this year would be a good baseline. For a second time, Australia has cancelled the visa of Novak Djokovic. Immigration Minister Alex Hawke overrode a court ruling that temporarily prevented the government from deporting the unvaccinated tennis star. Hawke said it was in the public interest to do so. No response yet from Djokovic or his lawyers. A new study out today on the Omicron variant from South Africa, where it was first detected. Researchers say that Omicron causes less severe disease than the Delta strain, even in those who are unvaccinated or haven't had a prior COVID infection. That adds to evidence that whilst Omicron is more infectious, it may be less virulent than some of its predecessors. The U.S. Senate has blocked sanctions aimed at stopping Russia's Nord Stream 2 pipeline. The Biden administration warned that the measure could disrupt allied unity in the confrontation over Ukraine. Opponents also said it's necessary to retain the threat of sanctions in order to prevent a Russian invasion of Ukraine in the future. And the loyalty of Cathie Wood's legion of fans may be finally waning. The sell-off in speculative tech stocks has handed the star money manager a miserable start to 2022. Investors pulling $352 million from Wood's flagship ARK Innovation ETF on Wednesday. The fund is down more than 15% since the start of the year. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Earnings season is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal.
Where are investors seeing the weaknesses?
It means profits down the line.
Earnings season on Bloomberg Television and Radio.
I certainly have not stated that we should do climate stress tests. In terms of supervisory guidance, what we tend to do is ask large institutions in particular, do you have a good risk management framework for assessing all of your material risks? We would not tell banks which sectors to lend to or which sectors to not lend to.
That was Governor Brainerd there, lined up to become the next vice chair of the Federal Reserve. From New York with Tom Keene, Lisa Bravitz and Jonathan Ferro, your equity market is down 6 and -0.1%. On the Nasdaq 100, down 31 and down 0.2%. Into the bond market, yields are higher by 3 or 4 basis points at 174. Let's call it 173.98 to be precise. And if you're looking at JP Morgan, the numbers out about 30 minutes ago. And as we've been talking around the desk, these banks and these numbers this morning capture so much about the stories of this moment. Rates are going up. Just look at the performance of the names year to date. The health of the economy has improved. Look at the reserve release from JP Morgan this morning, and it's getting more expensive to keep people. Look at the expense line. 162.90 in the pre-market, Tom. JP Morgan down more than 3%.
The final slide, John, speaks volumes in their 2022 outlook. And the answer is that James Dimon is going to listen to the computer scientist from the University of Dayton. Here's a name you don't know, folks. Lori Beer is maybe the most important person at Fortress Diamond. Here's why, John. She runs the technology, the information. She's got a fancy title on it. She's in charge of the computers. And they go to a $12 billion spend forward from $11 billion. They're spending way above where they were in 2019. And slide 14 and that outlook, John, is their 5-year manifesto forward on technology.
Tom, that's been a story over the last several years. Don't you think the story of the moment, though, the new one, fresh input, is compensation?
Absolutely, including in Ms. Beer's purview. There's no question, and this isn't about fancy investment bankers living in 6,000 square feet in Tribeca like you, John. This is about the entire. I can say this with a straight face, folks. This is about the entire bank.
People are going to be searching for me, Tom, on the wrong side of Canal Street. Okay, let's not encourage them. Carry on.
No, I think it's you're dead on about compensation, and it's going to be fascinating, particularly from the wealth managers. I mean, what was so important about what Ken Leon said there is Citigroup wants to be like UBS. How do you meet compensation with a profitability structure of wealth management versus banking, global monster like JP Morgan? It's a different world.
This is going to be the challenge for every single company, Tom, across every single industry, not just for the banks. These are the conversations they've got to have after a decade plus of saying, here's your pay rise in line with inflation, here's 2%. 2% is not going to get it done this year. And if you're working at a bank, everybody watching this program, listening to it, knows this is true. This is not about junior banker pay getting bumped up to 100K, which is a fantastic starting salary, by the way. This is about the people in the middle who have had the work pushed up to them from below, because the people joining these banks are getting paid more to do less. Let's be very honest and clear about that. They do not want to do that workload anymore because they cannot see the upside in the career in the same way they used to. And the people in the middle are getting the work pushed down from above. They're the people, Tom, that are pushing very aggressively to get pay rises this year.
John, I got bad news. Anne-Marie Horton's pushing very aggressively as well. I just got an email.
Are we going to struggle to keep her this year, Tom?
And I just got an email. If you don't give her airtime, she's going to have a Wordle tantrum. Anne-Marie Horton, good morning.
The Wordle was made for you today.
I want to talk to you, Anne-Marie Horton, exactly what we talked to Emily Wilkins about. Is President Biden making the miscalculation of his tenure by emphasizing the left versus the center?
Well, if you look at what Greg Valliere wrote, which I know you guys all looked at his note today, clearly what many think is this is potentially one of the worst weeks so far for the president, given a number of setbacks. When it comes to the Fed picks, he is clearly giving a nod and mollifying the progressive left when you see who he is picking, especially when it comes to Sarah Bloom Raskin. We've already heard from Senator Toomey, which is the top-ranking Republican on the Senate Banking Committee. We heard from him already. We heard from him again this morning in a statement, or last night after those picks were announced. And while he said he's going to look into Mrs. Cook and Mr. Jefferson, it's really about Sarah Bloom Raskin and his thoughts about her in terms of her writings about climate change and the worries that she would use the Fed to try to choke off some funding to traditional energy companies. So her confirmation could be very difficult, not just for Republicans, but some Democrats like Senator Joe Manchin of West Virginia that come from heavily reliant energy states.
Okay, highly reliant energy states. He's still mollifying the progressive left. How does he swing back to the center? I don't see how he does that before the Sunday talk shows.
Well, I don't see how either, because the Sunday talk shows, Tom, is in, 48, 72 hours. Potentially today gives him a little bit of that opening. He's going to be talking about roads and bridges, hard infrastructure, things that many in the moderate camp or even the right are in favor of. He's going to be introducing the $5 billion for bridges today. It's the 60th day since that infrastructure bill was signed into law by the president. Potentially this is his way to try to shift the conversation away from voting rights, away from Fed picks, and onto roads, bridges, broadband.
Lisa, to me, what's going on here is he can't talk to the center because they're all retiring.
Well, perhaps that's the case. Right now, though, I just want to pick up on what you were saying, Emery, Sarah Bloom Raskin, and how she's going to be difficult to confirm. She has been really vocal about banks and crimping down on some of their lending. We're getting bank earnings right now. How much does the message of banks are bad for making so much money actually resonating versus banks successfully marketing themselves as part of the solution during the pandemic?
Ooh, I think that's a difficult question. You saw in 2020, there was a lot of appreciation for what the banks were doing, given the fact that a number of people were having to leave work, working from home, and the banks really stepped in. But it's very difficult for politicians to really get behind Wall Street, especially when you see numbers like trillion attached to some of their management of money. When it comes to Sarah Bloom Raskin, though, and her thoughts on regulation, remember the progressives really were unhappy with Randall Quarles. They thought that he was way too lenient on banks, and she for sure is going to rule when that post a little bit more with an iron fist, and that is certainly going to get the nod from the likes of Elizabeth Warren, who we know was supportive of this nomination.
Was that enough airtime? That's all we need to know.
We didn't talk about Djokovic.
Do you want to talk about him now?
Oh, please.
Well, he was denied for a second time, and I think in tennis that's called a double fault. But yet we don't know where he goes next. What happens? Does he just go to the airport and leave, or is he going to continue to fight this out?
Not done. Seriously, it's done?
He's set to play Monday.
John, it's done.
Well, the minister has made the decision.
Yeah.
But as Anne-Marie points out, there's kind of this who knows vibe to this now. Does he appeal again? Is there another hearing? He's got a game to play on Monday. We'll see if he shows up for it. Anne-Marie, great work as always. AMH down in DC. Coming up, Seth Carpenter, the brilliant Seth Carpenter at Morgan Stanley on This Economy with retail sales 1 hour and 5 minutes away and some city earnings to get your teeth into as well. Good morning to you all. This is Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick is invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company. And we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly, to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We've got a ton to get through this morning, and good morning to you. About 1 hour away from retail sales, JP Morgan and Wells Fargo numbers behind us. In front of us is Citi. Equity futures right now on the S&P down about 0.25%. On the Nasdaq down 0.4%. On the Russell we're down 0.5%. On the S&P on a session we're lower. On the week we're lower. I want to talk about the banks year to date and what a run it has been for the S&P 500 banks. Year to date right now, up more than 10% into today on the session. We'll talk about JP Morgan and the pre-market with Romain in just a moment. We're a little bit softer. But Lisa, you and I have been discussing just how much the banks capture the stories of the moment. The health of this economy has improved. Look at the reserve release. That's been the story for so many people. The stocks have rallied aggressively. Look at the projection for interest rates and the expense line. This story about wages and compensation is not going away. This is just the beginning, and Lisa, you see it very, very clearly from JP Morgan this morning.
Yeah, their expenses really driven by the wages going up. I'm struck also by the price reaction in their shares, down nearly 3% in pre-market trading. Is this story of higher comp priced in?
And Tom, is this story of higher rates priced in? Because as some people have pointed out, TK, in 2 weeks, we've had about a year of performance on the S&P 500 banks. They're up almost 10% plus to 11.
Yeah, it's a movable feast right now, and on the rate front, I just will have to see. To me, to dovetail this, John, into the economy, the biggest surprise of the week for me are the pro-epidemiologists saying Omicron is going to end fast. How does that change dovetail in to the mathiness we're talking about?
It's already been in the story for a lot of people. You know, in the previous hour, I talked about Betsy Grasick of Morgan Stanley, who lifted Wells Fargo to overweight at the start of December, looked through Omicron, looked at the prospect of higher interest rates and went overweight. That stock delivered. This sector, this industry has delivered in a big way as well. Switch at the board and let's finish on the bond market just briefly. 2s, 10s and 30s going into retail sales a little bit later on a 10-year. Wood 74.15 yields higher by 4 basis points on 2s. A similar story up 3 to 0.92. We had a little look at 93 earlier on. That's the cross asset price action. Let's get you some single names, some moves and kick things off with those banks and say good morning to Romain. Morning, Romain.
Absolutely, John. And you put it in the context of the broader market. One of the bright spots over the last couple of weeks has really been the banks. We did see a pretty decent rally heading into these earnings. JP Morgan shares down about almost 3% here in the pre-market. Let's keep in mind they missed on FIC trading, they missed on equity trading, they missed on equity underwriting. There were some bright spots there with regards to that investment banking unit, but of course, as you guys have been talking about all morning, this isn't just about the revenue JP Morgan pulls in, it's about the payouts that they're having to make to retain some of that talent. Those compensation expenses significantly higher, non-interest expenses also higher here as well. Will be interesting to see what they talk about on the call with regards to how persistent some of that's going to be. Wells Fargo actually surprising here. Remember, this is a business much more built around loan growth, and they actually saw some of that loan growth in the most recent quarter. We should point out that you saw some pretty healthy spending with regards to credit cards and also auto loans, but as we pointed out, auto loan growth was primarily driven to the value of those individual loans rather than the volume itself. You saw a slight drop with regards to home lending as well as some of the personal loans. Nevertheless, those shares up about 2.7% right now in the pre-market. The CFO, Mike Sanamisimo, he's going to be on the close a little bit later today. First Republic, which is primarily a private bank, wealth management, had some decent earnings as well, up about 1% here. Flip up the board real quick, a couple other things to keep your eye on. A downgrade for Disney over at Guggenheim. Those shares down 1.5%. And the casino company is doing well here, Tom. If you want to take a trip over to Macau, the new rules for casino companies over there just came out, putting a cap on the number. That's good for the companies that already have a presence there. Las Vegas Sands up 11%. Wynn Resorts up about 10.
Romain Bostic, thank you so much. Greatly appreciate it. There are all sorts of ways to go here, and what we're going to do now is step back and go deeper and richer. You can do that with Seth Carpenter, Global Chief Economist at Morgan Stanley, who's not looked at the cursory of trade, etc., but maybe tearing a page from the laureate Angus Deaton of his Princeton. Seth Carpenter has really dove into the dynamics of trade. We're going to go beneath the headline data. Seth, I love your work, your calculation of the supply mess we're in, and you go to intermediate goods. What is an intermediate good, and explain the complexity of that for America and China?
Thanks, Tom. You're always far too generous. So intermediate goods and why they matter for trade, they are not the finished consumer goods, not the finished goods that are going to get sold. They're the inputs to that production. And so if you think about the production, the manufacturing that actually gets done here in the United States, you got to get the raw material somewhere. You can sometimes do it from base materials, but often the final assembly gets done using parts that were partially made in other countries, and those are the intermediate goods.
Do you predict forward buoyant trade as a general global statement that buoys all nations?
So I think that is an open question at this point. The trade really did roar back as we were coming out of COVID, and it was led by consumer goods. And we all know a big part of what went on with inflation was this big demand for consumer goods being choked off somewhat by a less elastic supply curve. But goods trade came back a lot. Capital goods and intermediate goods started to take over. We've now started to see a little bit of a turning there, a slowing in trade for goods. Services are coming back, except for tourism, right? And so that's going to be key. That's going to be sort of the real question about what happens with Omicron. Does it fade out quickly? Is it benign over the next quarter or so, like everyone's hoping for? If so, we could get a recovery in trade. So we started off with trade in goods. We're hoping we're going to get a shift to trade and services.
And one thing underneath the hood of this increase in trade is that you see signs of supply chain disruptions easing, which is something people have been waiting for. How quickly will they ease and allow some of the disruptions that have been really feeding into inflation to abate?
So that question is just 100% key for the inflation debate, and as a result, the central banking outlook and everything. So we constructed this index, taking lots of different series that relate to supply chains, and it does look like over the past month or two, those supply chain disruptions have peaked and started to come off. If you also think, okay, two things are causing these frictions: the supply side itself, and then the really, really strong demand. Maybe we're starting to see an easing in the demand side of things as well, and that's going to ease some of these frictions. We think that we've turned the corner. How fast it goes back to normal is a very, very difficult question. We're optimistic that by the end of 2022, we will be close to normal. And if that's the case, then inflation should start to come off over the course of the year. But as everyone knows, over the past 6 months, inflation pressures have been higher and more persistent than expected.
Which really dovetails into the story that we've been talking about all morning with the bank earnings, the idea of higher compensation and wages picking up where supply chain disruptions left off and really adding to some of the inflationary pressures. Do you think that people are correctly pricing the wage increases that we're expecting to experience later this year?
Yes, to a large extent. I think there is definitely a lot of focus on that. One point that I would make is that there's a very, very cyclical component to labor supply. And what we have seen over the past year is that prime age labor force participation has actually gone up by over a percentage point. We expect that measure of labor supply to continue to rise over the course of this year. That doesn't mean that wage inflation is going to go away. It just means that it might not be quite as bad as I think some people fear.
What does ECI Dynamics do when we say wage inflation, the dreaded wage spiral that Ellen Zentner talks about? Is it wages or is it benefits as well?
So it's got to be a combination of things from a business perspective when you're looking at the bottom line for businesses. And so when my colleagues in the equity research group are thinking about it, both wages and benefits can take away from the bottom line. I think, though, what gets more challenging from a big picture top-down perspective is what role does either of them play directly feeding into consumer price inflation. They tend to move together, that's for sure. But we did some work a while ago that if you look at what the impulse from wage inflation, whether measured literally as wages or as ECI, going to price inflation on its own, there's actually been less and less and less of that effect over the past few decades. So that's another reason I think why we're slightly on the lower end of the distribution in terms of forecast for inflation at the end of this year.
How closely are you watching the earnings season that we just embarked upon?
Anybody who's in research at an investment bank always gets caught up in it. I luckily get to step back a little bit from the fray. You mentioned my colleague Betsy Graysick's call for Wells. It's for me a really great season because I get to learn a lot from my fantastic colleagues in equity research and try to make sure there aren't any tweaks we need to make to our macro outlook.
Send our best to Betsy. That was just a great call, Seth. Going overweight wows at the start of December. Seth Carpenter there of Morgan Stanley. Thank you, sir. A tremendous 12 months as well, to be fair to Wells Fargo, but particularly some of that move concentrated in the last couple of weeks or so. Here's some numbers from BlackRock in the last 60 minutes or so. Asset under management 10.01 trillion. The estimate 9.85 trillion. Robin Wigglesworth, a correspondent at the Financial Times, fantastic author as well of Trillions on the shift to passive investment, tweeted this out, Tom. The combination of rising markets and strong inflows meant that BlackRock's assets under management climbed 1.33 trillion last year. Here's the interesting piece of that. That's the equivalent to adding an entire Schroders, almost an Invesco or T. Rowe Price, and 3 Janus Hendersons in 1 year. And that's the story of BlackRock of last year, Tom.
John, you look back at all the conversations, and I did a thing with the late John Bogle and with Cliff Asness that was absolutely brilliant. And what's frightening to me is, just as you correctly state, it's not about the moment, it's not about the year, it's the cumulative thing that John Bogle at Vanguard did. It's the cumulative math that Cliff Asness is expert at, and it accumulates up. Where are we going to be in 10 years, John?
No idea. But given where we've been in the last 10 years, those numbers could be even bigger. Lisa, those numbers are just massive.
Yeah, I'll give you some other massive numbers, thanks to Shonali Basak. The compensation expenses over at BlackRock rose 16% for the quarter, almost 20% for the year. So expenses there rising as well.
Tom, you know what I often think about? Can you imagine if Bob Diamond still was at Barclays and managed to keep hold of that passive business? Can you imagine what that could have looked like?
There's a lot of that. There's a lot of shoulda, woulda, coulda.
Just amazing.
He's just rubbing it in.
No, I just think, just looking back, I just think I've spoken to Bob about it over the years. Just amazing.
Well, you've got 6,000 square feet in Tribeca, and I think he's got 8,000 right next to you.
I've already got people writing in to see if they can borrow the apartment, Tom. Don't encourage it. We're down 19 on the S&P. We're down 0.4%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The U.S. Supreme Court may have rejected President Biden's mandate for COVID vaccinations or testing, but businesses threatened by Omicron spread might be forced to implement one anyway. That's so they can protect their workers and keep factories open. The court's ruling still lets businesses require vaccinations. Bloomberg's learned that President Biden plans to nominate law professor Sarah Bloom Raskin to be the Fed's top banking regulator. That's seen as a nod to progressives who wanted someone who is more pro-regulation. The president also plans to name economists Lisa Cook and Philip Jefferson to be governors. Cook would be the first black woman on the board, and Jefferson would be the fourth black man. North Korea appears to have fired 2 short-range ballistic missiles. The launch came hours after Kim Jong-un's regime warned it would take stronger and certain action. After the U.S. imposed more sanctions earlier this month, North Korea conducted 2 separate launches of a new hypersonic missile system. And it's the latest sign of momentum in SAP's turnaround plan. The German business software company says that cloud sales accelerated faster than expected in the fourth quarter. It rose 28%. SAP is pushing customers to migrate to the cloud and to adopt a suite of new products. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be, how quickly can we, all of us, execute to build capacity to meet that demand? And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Investors are starting to move away from the big mo, and that big mo for many years, of course, was fixed income. I worry much more so about individual investors, many of whom haven't yet figured out the damage that could occur to their personal portfolios as interest rates begin to rise.
A clinic, as always, from Abby Joseph Cohen, the professor at Columbia Business School, from New York City with Tom Keene, Lisa Brabbitts and Jonathan Ferro on this earnings day here in America, with JP Morgan leading the way, with BlackRock, with Wells Fargo, Citi still to come. Yields up 3 basis points on 10s to 173.45. Equities down a bit, down 18 with negative 0.4%. There's a big story this morning on Wall Street, Tom. People are getting paid a whole lot more.
Getting paid a whole lot more, and we're going to wait for Citigroup here to give us a big change. I thought it was fascinating how Ken Leon equated the new Citigroup, the Frazier Citigroup, to what we see at UBS, and we'll monitor that. We may see that early, but we're scheduling that here in about 12 minutes. Retail sales at 8:30. There are points where you stop, and a decade ago or so, I was interviewing some food guru at the United Nations, and I stopped when he tried to explain to an idiot like me what you spend on food in Cambodia. And here's the math. You spend 70% of your income in Cambodia on food. It is not the United States of America. Kriti Gupta gives us perspective. Kriti, what do you have?
Yeah, well, I'm looking at exactly those food prices, Tom, especially from that UN Food and Agricultural Index that goes back on a monthly basis really to the highest level since 2010 and 2011 to really highlight just how extreme the move is. Well, the last time we were at these levels, there was a gigantic food crisis in the world. You had droughts, you had a crop crisis in Russia, which is one of the major wheat kind of producers of the world. So to see that kind of extreme mood really tells you that this is going to be an issue that affects the bottom line of a lot of folks. And to really bring it back to the United States, you also have retail sales, like you mentioned, coming up at 8:30, and that's going to be crucial because in the last data set, the biggest contributor was food prices.
I think we're hugely guilty. I'm hugely guilty of an elite perspective where food is an afterthought. It's not, even in America, it's not an afterthought.
Yeah, and that's totally true. When you mentioned Cambodia, but I'm looking at Mexico, for example. If you look at their inflation numbers, they actually had to hike more than perhaps any other EM country. The biggest driver of that, and then Colombia as well, were food prices, fresh food prices. You saw that on the earnings perspective as well. Albertsons came out and said the majority of their transportation costs, their logistic costs, was coming from fresh food prices.
One of the confusions right now, Critty, is how inflation dovetails into growth. How much does it crimp growth? How much is it just a symptom of a really positive economy? How much, based on your conversations with strategists, has the higher costs of base items that people buy crimped their demand for other items or not, as we may see in about 40 minutes time with retail sales?
Well, it hasn't yet, Lisa, and that's really the concern going into 2022, because you remember you still have the effect of that fiscal stimulus. There are still savings that people are drawing upon, so they're able to spend money on, say, clothes and food. But when we talk about just the impact of what's actually driving this inflation, it is a little bit of a chicken and egg situation, because you do have those supply chain issues that are pushing the costs higher, but you also have demand pushing it higher. So you kind of have this double whammy that ends up with higher prices overall, and that's going to be a story that you see in the oil market as well. You see it in the food market, and you're certainly seeing it in things like furniture, apparel, and other consumer products.
Critty, one reason why you have incredible perspective is you look at some of these underlying economic trends and dovetail it into markets. And what we just saw from JP Morgan was an unexpectedly high rise in compensation costs and expenses, which some people are wondering about. How much, from your discussions with analysts, have people accurately priced higher wages, higher input costs in corporate America and beyond?
Well, they've definitely priced in the higher input costs. The wage costs are really where it's getting tricky, because if you look at just the earnings stories and some of the bottom lines, I'm going to look back to the third quarter because we're still just starting to get the fourth quarter results out. But in the third quarter, a lot of these companies had priced in higher commodity costs because they could do that, forecasting it back to, say, 10 years ago in the post-recessionary period that followed 2008. What they can't do is price in those wage costs because, I mean, we've covered this all over Bloomberg all day long. There are wage costs. There is a very high quit rate. You are also seeing the fact that there is this trend where people are actually working not typically into the office, and that's something that you can't exactly quantify. You can't map out. That's something you have to do play by play.
What are you looking for next week? I mean, you're out front. Folks, the truth here is that Critty Gupta's, her charts, she's got like 47 in reserve at any given time. What are you looking for next week?
I want to look at the commodities story because you are still going to get
beyond
banks.
oil.
Beyond oil.
Thank you.
Yes, you're going to look at copper. You're going to look at aluminum. Aluminum in particular, because those Russia talks are still going on, and that's going to be a big price factor into aluminum and specifically.
Pro-surveillance tip: quote copper off the LME, or the guy with a British accent won't have a tangent.
Actually, it won't be me, Tom. It's usually you. You get upset about that more than I do.
Well, I don't know. There's Chicago folks and there's London LME, and John and I have a proclivity to London, even though many, including Jeff DeGraff with a smart note this week, owning copper as well. Is it Dr. Copper, Critty Gupta?
It's Dr. Copper. Can I just really quickly mention the LME part? Did you see that story?
Taking over?
I'm not taking over, but did you see that story that there were an electricity outage at the LME and it actually affected prices for a hot second?
They had to move to the Dorchester Hotel? That's amazing, John.
Let's be clear here, and Critty, thank you, by the way. Lisa, this is the only reason Tom ever brings up the London Metal Exchange, because of LME Week, and he wants to go back to the parties of yesteryear and go to the Dorchester.
Yeah, how much?
That's all this is about.
You know, honestly, how much of the mentions are simply to get a road trip? I mean, they're petitions for road trips.
That's all the mentions are ever about.
I went with my entourage, and one of the members of the entourage it got a yellow umbrella, sort of like Boilermaker Purdue. She still, it was in her drink, and she still uses that umbrella in the rain.
I think she's our manager too, Tom. Tom Keene, Lisa Abramowitz, and Jonathan Ferro. On this earnings season day here in America, with equity futures down 18, we're down 0.4%.
The tang is good today.
We're down 105 on the Nasdaq, down another 0.7%. Look out below there again as yields climb back to 173.27, up 3 basis points. Citi still to come. We've had JP Morgan, we've had BlackRock, and there's a theme here already, Lisa, for this earnings season. We had some pretty decent insight into it for the fourth quarter. Wages are going to be up. They're going to be up big.
And I keep asking whether it's priced in because JP Morgan shares are down and there are some questions about whether it's worthwhile. I'm curious to see with Citigroup, and actually over at Wells Fargo, which is seeing its shares up a bit in pre-market trading, their headcount dropped more than expected. And I wonder how much lower overhead factors into that.
To be fair to Larry Fink over at BlackRock, I think he got ahead of a lot of this, Tom.
Yes.
He got ahead of it before we saw the 7 handle on inflation. So the quote that we read out this morning, and Lisa picked up on what Shanali pointed out, well, that starting back in September, base salaries rose 8% for all staff at the director level and below. That was a story at the end of last summer that came out, and Larry Fink talked about it. He just said across the board, director and below, 8%, let's go. That was before we saw the 7-handle, and I think he got out ahead of this in a pretty decent way, Tom.
On the break, John, I was thinking with that while you were talking to Lisa, not to me, and there's no question Larry Fink absolutely nailed that. To be honest, on a labor basis, maybe he's the executive of the year in finance.
Yeah, making the call at the right time, Elisa, and everyone else, Lisa, seemingly chasing their tails into 21, 22 and beyond.
Yeah, how much was that JP Morgan's Jamie Dimon's reason for coming out and saying this wage increase is unlike anything I have seen in my career, as he did earlier this week?
Yeah, and do they have to repeat the act?
Yes.
Is the thing we need to talk about next year. Who's scared of a wage spiral? I would say economists, and I would say CEOs. I mean, me personally, not afraid of them. I think they're great. Yields up 3 on 10s, 173. Futures down 0.5%. This is Bloomberg.
How all that chocolate makes it to the supermarkets in time for Christmas? I'm James Walcock, and I got really curious how chocolate makes its way to the supermarkets every Christmas. So I came here to Nestle's distribution centre to find out how it works. Almost 120 lorries come here every day, and they drop off coffee, chocolate, Kit Kats, Toffee Crisp, you name it. If it's made by Nestle, it will come through here, and it will get sorted by machines who will then load it onto a monorail that runs right up and down the facility. Automated cranes, like this one coming in behind me now, then load all of the chocolate, storage, all of Nestle's goods into this big warehouse. It can hold up to 100,000 crates. And then after it's been sorted and stored, sometimes for months, it will then end up over here, where then lorries will then take it out to supermarkets up and down the country. You can see the entire process is done without people. Goods can come and leave, sometimes without ever touching human hands. It's one of the largest automated centres in the UK, and it opened during COVID. So this Xmas is its first big test, and so far, it looks like things are going well.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
push-pull between the fear of the Fed and Fed moving off ultra accommodation.
It's pretty clear they're telling us the plan is to go in March at this point.
They want to get to the balance sheet sooner than later.
Markets are a bit underpriced for the potential for an increase in the terminal rate.
The stock market has been extraordinarily skeptical of the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is an hour of retail sales, I should say, but most importantly, it is an hour of banks. We heard J.P. Morgan, John Farrow earlier, the excellence of Fortress Diamond. Frazier, 1 year in at Citigroup, has a different story to tell.
8:30 for retail sales. I'll go through Citi line by line. Investment banking revenue, $1.85 billion. The estimate, $163. It's a tidy beat. Just a touch lighter on FIC and equity sales and trading revenue. Equity sales and trading revenue coming in at $785, the estimate $835.5 million. Fixed sales and trading revenue, Tom, coming in at $2.54 billion, the estimate $2.69 billion. The story of Jane Fraser and Citi, though, Tom, not about the quarterly earnings. There's been a lot of rejig geographically around the world, a big rejig. Fraser saying Citi has now announced all market it intends to exit. So I butchered that. I'll read it again. Jane Fraser and Citi saying, thank you, Tom. Deep breath. I'll re-begin. I'll restart. Citi has now announced all markets it intends to exit. So after this geographic rejig over the last few months, that should be it now, according to Jane Fraser, Tom.
That includes retail in Mexico. And I want to do a compare and contrast to Lisa Abramowitz here. We mentioned up 15% over decades with J.P. Morgan. Citigroup, what a different look. The last 10 years, up 3.5% per year. The last 20 years, negative 8% per year. The last 30 years, single digit and lousy single digit, Lisa, up 5%.
Yeah, and what we're seeing is them trying to simplify. The question is whether they're getting it done right now. The reaction in the market is a lower, down about nearly 2% at one point. What I think is interesting is this idea of they're trying to move toward something that is streamlined while underperforming on the trading side again. And this is also what we saw out of J.P. Morgan. What happened with fixed income? What happened with equity trading? It seems like a reversal after a couple of really blockbuster years.
Right now, futures negative 33. We're going to skip the data check now. John and I will fit that in as we go to retail sales here in the next 30 minutes. Right now, Shonali Bassick with us, and we're thrilled to continue with Ken Leon of CFRA today. Ken, we've identified out here that Citigroup is not J.P. Morgan. What is the urgency Jane Fraser faces to right the ship and move forward?
She wants to have a great narrative for the investor day, probably in March. And this is cleanup. This is getting out of consumer markets where it's hard to manage those businesses and they take up a lot of time and you're not going to get rewarded in the stock. So they're streamlining to have a presence outside the U.S. in corporate investment banking and wealth management. This means they'll be able to reduce expense. I think that's her big case for the strategy. But it's going to take time to get out of those markets in terms of closing the deals. Jane Fraser's on the right track. It's just going to take longer than doing just a domestic turnaround, which Charlie Scharf is doing at Wells Fargo.
I want to bring in Shonali as well. We've been talking about Jane Fraser for a while now, Shonali, about where she would exit, where she would stay. It looks like that is complete. Was that the expectation this morning?
No, well, there was a big reshaping of the Citigroup in the last year, and the idea that this will cost billions of dollars has been soaking into the market. Now what the market wants to know is when are they going to start returning more capital to shareholders and start expanding in the businesses that they can excel at. Now, I want to point to some of these institutional client group numbers because the fact that they fell below expectations, John, is a big deal. The institutional client group had grown on the quarter, whereas global consumer banking has fallen. And remember, consumer banking is where Jane Fraser has her background and is really expected to grow the business. So the numbers alone show still a need for improvement on performance, especially in trading, as investors are going to want to see her hang on to investment banking and trading as she reshapes that consumer bank.
Which really goes, Ken, to maintaining talent at a time of talent wars, having to pay up to compete with the likes of J.P. Morgan at a time when you're trying to reduce costs and you're dealing with some units that are not necessarily outperforming. And I think of, again, the fixed sales and trading that underperformed and the equity trading that actually was a surprise miss as well.
It is. And, you know, it's hard to compete with companies that are focused, streamlined, and the other issue with Citi here is, they got $400 or $500 million of added costs for compliance and regulation. So while some of the other banks are investing in technology, to your point about trading or servicing corporate clients, they still have to be more compliant with U.S. regulators, and that's costing them. That's really part of the reason why Jane Fraser took over last year.
Why is FIC short? In FIC, I mean trading in bonds and equities. Trading is a dangerous word here. Ken Leon, explain that to us. Is this a VAR mistake? Is it a trading mistake? Or is it some form of institutional reorg that causes underperformance?
It has to do with allocation of regulated capital and principal transactions for fixed income commodities or currency. You're putting capital at the table, less so in terms of equities. And also, for investors and really analysts, it's hard really to forecast quarter to quarter what goes on in trading. But ideally, you really want to get the maximum trading with the lowest amount of capital that you have to put on the desk. And that's kind of the environment we have today. Very different than 10 or 15 years ago.
The fees in investment banking are just absolutely stellar. The team on the live blog here at Bloomberg breaking it down. Overall investment banking fees up 43% to $1.8 billion. The team here at Bloomberg News pointing out that M&A was all where the action was. And Shonali, I wonder if we've got a decent enough read now, looking across Citi, looking across JP Morgan and Wells, to get a tidy read for what's going to come next week.
Yeah, we do. We know that it's going to be a very choppy period for investment banking revenue. That is a good number over at Citigroup. But remember, when you look at the league tables, we've seen Citigroup fall a little bit below some of their peers, a little bit below Bank of America, which has been investing heavily in investment bankers as well, their closest peer in that regard. And Citigroup was a big SPAC banker. The SPAC market is now cooling quite a bit, so can they keep that equities revenue up? These retail banking figures, investors are going to want updates on their almost declines across the board. So what is it going to take for cards, for retail banking to turn around for Citigroup as they do all these other very complicated changes? Ken is absolutely right. That March Investor Day will be a pivotal moment for Jane Fraser.
Shonali, thank you so much. Shonali Bassick with us. And Ken Leon, always thank you to all of us with CFRA. Right now, we dovetail into futures negative 30, Dow futures negative 206, a VIX up a solid stick nicely through 21.37. And we get perspective from Scott Clemens, Chief Investment Strategist at Brown Brothers Harriman. Scott, it sort of felt like a year so far. Maybe it's at least a quarter here in the first 14, 15 days of the year. Have you changed your outlook since 12/31/21?
No, I don't think so, Tom. I think what we've seen in the first handful of weeks of this year, if anything, is a microcosm of how the year is likely to unfold. If anything, the surprise in 2021 was the relative lack of market volatility. We only had 7 trading sessions last year in which the S&P 500 index moved by 2% or more up or down in either direction. And usually in a given year, we have about 20 days like that. So we're cautioning our clients that given all the transitions taking place, and we could talk about that for the rest of the day, that there is likely to be more market volatility in 2022. That may be a risk, that may be disruptive and anxiety inducing. It's also an opportunity as well for investors.
How do you use it then as an opportunity, Scott?
Well, really, when you get that dislocation between price and value is what a disciplined, long-term, patient investor can exploit. And what that really is not so much knowing something more than the market or knowing something more than another trader. It's having a different time frame for making that investment. So if you see a company stumble in the near term, but you're confident in the long-term fundamental value direction of the business, that near-term stumble, maybe a near-term EPS miss, a product miss, whatever it may be, is more of an opportunity than it is a threat.
Scott, I want to go to the story of the moment. It's the banks this morning. They're just killing it. Year to date, the stock performance more than 10%. A bit softer on the morning. Some people unwilling to chase this. What advice do you give them?
Jonathan, to take the same kind of long-term approach. This is an environment which ought to be better and better for banks. Banks are certainly undervalued relative to where they've been over a long run. Higher interest rates ought to be beneficial for banks. But as you and Shonali just reported on Citigroup, there are a lot of moving parts within the banks, be they regulatory or be they a market environment, where the revenues are coming from, higher costs of employment. when they can get back to offices, et cetera, et cetera, et cetera. So it is an environment in which there's going to be a great deal of volatility. I'd stay focused on the longer term.
Well, focusing on the longer term, though, and this really goes to the heart of the moment, which is what is being priced in from an interest rate perspective, from a wage increase perspective. How do you determine that to decide whether or not to say Citigroup down 3%, having a really rough time of it over the last 12 months relative to other banks? Let's go.
I think the interest rate environment is probably the most important economic backdrop over the course of this year. And it's really important. This is a subtle nuance, but it's an important one. The important thing for markets, the important thing for banks in particular, is not that interest rates are rising, but why they're rising. And that's admittedly subjective, and the push and pull in markets, even on a day-to-day, hour-to-hour basis, might be precisely that. On one hand, if interest rates are rising because people are more confident in the economic outlook, the durability of the labor market, the sustainability of corporate earnings, et cetera, that's a benign backdrop in which banks can do well and in which the market can do well. If, on the other hand, the market concludes that interest rates are rising because the Fed has lost a grip on inflation and they're behind the curve and they're rushing to catch up, that's a rather negative, a rather disruptive outlook. And I think there's going to be a lot of push and pull back and forth on that as the year unfolds. We even see that, to my earlier comment to Tom, as a microcosm within individual trading sessions. I'm confident that when all is said and done, this transition of economic leadership away from policy support, government support, monetary policy, back to the more traditional fundamental drivers of economic activity, household spending to name the most important one, that will take place, but it is not a straight line between here and there.
Scott, thank you, sir. As always, Scott Clemens there, the Chief Investment Strategist at Brown Brothers Harriman. When you're looking at these moves this morning, we're down 3% at JP Morgan, on Citi at the moment down 3.36%. You've got to remember where we've been coming into today, Tom. Citigroup on the year coming into today up more than 12%. Yes, it's softer this morning, down 3.5%, but it's up more than 12% year to date.
Yeah, the moves are there, John, and the banks are all different. But I find the Citigroup story, John, absolutely fascinating. Wells Fargo seems to be getting it done in terms of a lot of challenges and really shifting around to trying to do something new for Wells Fargo. Do you have that feeling for Citigroup? I don't yet.
A step at a time. Lisa, first of all, Jane Fraser
Yes.
comes in. She's got to work out simple questions. Complex answers, I know, and complex processes to go through. Where do I want to be? Where do I want to be in the world? What does our footprint look like geographically? And it looks like they've done with that. Now it's on from there.
And how do you maintain the talent at a time of talent wars and increasing compensation when you are trying to rejigger everything and craft a new strategy? It's really a complicated thing to get done.
Lisa Bramage, Tom Keene and Jonathan Ferro kicking off earnings season on Wall Street with JP Morgan, Wells Fargo and Citi. Next week, Goldman, Bank of America, Morgan Stanley and the rest. Futures down 33. We're negative 0.7% now. On the NASDAQ 100, we're down 0.9%. Yields are higher. Compensation on Wall Street is too. From New York, this is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal.
Where are investors seeing the weaknesses?
It means profits down the line.
Earnings season on Bloomberg Television and Radio.
The problem that you have early in the year is the Fed is in a box. You have monetary policy uncertainty, you have fiscal policy uncertainty, you have economic policy uncertainty, and some geopolitical issues. So we expected the volatility early in the year, but I think it's going to end the year on a really good note on earnings.
A pre-weekend gift to catch up with Tony Dwyer, equity strategist at Canaccord Genuity, with Tom Keene, Lisa Bravitz, and Jonathan Ferro. Your equity market down 28, we're down 0.6%. We're negative. The Nasdaq 100 down 0.75% right now. Cash is doing something, Tom, something it wasn't doing a year ago. Yields are higher on 10s by a couple of basis points to 172.56. Shanali Basak listening to the JP Morgan media call right now. Just ping this line over to us, Tom. Jamie Dimon on inflation. Hopefully, it will start to come down over the course of the year. However, it's clear to me that wages and oil and housing are not transitory. The line there from the JP Morgan chief, Tom.
Yeah, they'll parse every word of it as well as we dash into the first quarter of 2021. We've got retail sales coming up here in 12, make it 11 minutes. That's important. I know Lisa and John want to jump into that. But I want to give you a window, folks, into the depth of knowledge of our economics at Bloomberg. And, of course, that leadership is always Michael McKee. Lisa Cook, what a privilege to study under Barry Eichengreen and David Romer at Berkeley and Philip Jefferson at the freshwater camp of the University of Virginia. These, whatever the politics of the moment, these two have the chops, don't they?
Well, all three of them have the chops. Sarah Raskin, nominated to be the vice chair for supervision, is a former deputy treasury secretary, former Fed governor, former bank regulator. So she's got the background. As you mentioned, Cook is a very familiar face around the Fed. She attends Jackson Hole every year when they have the Jackson Hole meetings. And Philip Jefferson is He's been an academic for 20 years, spent some time at the Fed, written a lot about income inequality issues that are coming up right now. So there is a group of really qualified people.
One more question on this. I know we got to get to retail. The opposite side is going to go, these people aren't Lael Brainerd. They're not Richard Clarida. They're not published monetary economists. Philip Jefferson owns the high ground on poverty. He wrote the very short introduction for Oxford, which I've said for years are just great vehicles. Why shouldn't we have someone in social economics on the committee of monetary policy?
Well, we probably should, and the two will bring great diversity to the Fed. Lisa Cook would be the first black woman ever appointed. Philip Jefferson would be only the fourth black man ever on the board. And if both of them are confirmed, along with Michelle Bowman and Lael Brainerd, the board would be majority female for the first time ever. But there are going to be some bumps along the way. Sarah Bloom Raskin already attracting fire because she's been outspoken on climate change. When the Fed was lending to companies back in the 2020 crisis, she said they shouldn't lend to oil and gas companies. She said fossil fuels are a terrible investment. Pat Toomey, the ranking Republican on the Banking Committee, who is going to be in charge, the Banking Committee is in charge of her confirmation, has already come out with a sharp statement saying that he thinks she would abuse the Fed's statutory mandates. And so the Republicans
My statutory mandate is to go to Lisa Abramowitz.
To oppose her.
Well, we talk about social concerns, and there is really the pressing social concern of wages, which we've been seeing from all of the banks. And, you know, obviously this is a different story than the vast majority of the nation. John asked earlier, who's afraid of a wage spiral? How many people on the Federal Reserve, including these nominees, if they make it to the Federal Reserve, are afraid of a wage spiral right now?
Well, a wage spiral they'd be afraid of because that just continues the drama. It means that companies then raise prices to keep up with wages, and then workers come back and say, we want more money because prices went up. But they are in favor of higher wages for workers and more money going to labor and out of capital. The Fed can't really do a whole lot about that. What they tried to do was keep the unemployment rate as low as possible on the theory that a rising tide lifts all boats. But there really isn't a legal vehicle for the Fed to do a lot of social engineering.
And there's an issue as it applies to the retail sales that we're about to get. How much are people continuing to buy despite the higher headline prices? What are we expecting, parsing out, backing out some of the inflation, the fact that each ticket item costs more, to get a sense of whether people are getting a little bit discouraged seeing the sticker price?
Yeah, it's something we're going to have to take a look at, Lisa, and try to figure out in terms of inflation-adjusted numbers, because the more, these are numbers are reported in nominal terms, so the more they cost, the more it appears retail sales have gone up. But we have a little bit of trouble doing that because people also were warned that there wouldn't be anything to buy for the holiday season. So they started buying much earlier. So it may be over a period of time as much was spent, or we bought as much stuff, and it's not as inflation affected yet as it could be.
Christmas came early. Bank of America out early with that line in the back end of, I think, Q3 going into Q4. Mike, thank you. Michael McKee there. Just looking at this market at the moment, down 0.7 on the S&P. We're down 0.6 on the NASDAQ. We're down 0.7%. Clear trend in the bond market, yields higher. And we spend the whole week, Lisa, talking about higher interest rates. I can't think of a single policymaker that isn't talking up 3 or 4 rate hikes in 22.
Well, can you say, though, that this is a rate hiking pricing, or is this the issue of people wondering whether we've priced in some of the wage increases, the expenses that a lot of companies are going to face? Have we accurately cast out and gamed out how this will affect the bottom line at a time of real uncertainty economically?
So we thought the margin story would be one for last year, particularly the back end of last year. It didn't happen. Margins were really insulated. Are you suggesting that that could be the story going through 22?
I just wonder how this plays out as people get back to normal and as we start to see people, exactly to your point, John, see that the real price of the stuff they buy has increased 7% year over year. A 3% wage increase isn't going to cut it. So how is that factoring into all of these companies that are also seeing record vacancies, having to offer that much more to new employees coming in the door? How do we price this in?
It's not just the annual wage negotiations, Tom. It's the long-term wage negotiations that developed as well over the last several months, looking at the next several years. I remember that blog piece that came out from Neil Kashkari, the Minneapolis Fed president, who suggested that's what got his attention, really caught his eye, is that multi-year wage negotiations now, we're now factoring in something closer to 7, when typically they were looking at something 2 to 3.
I'm going to take a decile analysis, John. The government does a really good job of this. Mike's way more expert at this than I am, but I'm going to suggest the bottom decile, maybe the bottom 2 deciles, 20% of the public, let's say, they're doing okay. The top decile, we know they're doing okay. It's the great middle, John. I really wonder what they're going to do with this inflation.
Over to you, Chairman Powell. Jamie Dimon at JP Morgan saying, I have a lot of faith and trust in Fed Chair Jay Powell. The line coming from the JP Morgan chief. Right now, equities lower, down 27, down 0.6%, down, let's call it 110 on the NASDAQ 100, down 0.7%. Yields are higher, but off the highs of the session, up a single basis point on 10s to 171.85. On 2s, we've gone through 80, through 90. On a 2-year yield right now, just south of 92 at 91 basis points, up 2 basis points on the day. And Tom's been talking about crude through the morning, briefly with an 83 handle, now 82, breaking to 81, 81.99 and down about 0.1%. Retail sales in America up next from New York. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Retail sales in America just seconds away from New York City on TV and radio alongside Tom Keene and Lisa Brabbitts. I'm Jonathan Ferro. Futures down 28, down 0.6% on the S&P. On the Nasdaq 100 down 127, down 0.8% now. Yields higher by a single basis point on 10s to 171.68. Bit of data out already. Retail sales dropping right now. To Mike McKee for more. Hey, Mike.
Hello, John. It is a lot worse than anticipated, whether it is because we couldn't sell cars or because everybody bought their Christmas presents in October. Retail sales down 1.9% in the month of December. The forecast was for a drop of 0.1%. So that's quite a shortfall. Ex-autos down 2.3%, and you take out gasoline as well, down 2.5%. So a big miss for retail sales. And the retail sales control group that economists follow, because it's the stuff that kind of goes into GDP, down 3.1%, was expected to be flat. So a real drop here. And I'll just mention that import prices come down 0.2%, but leave out petroleum and they're off. They're up by 0.3%. So import prices still rising, up 10.4% on the year. You want to check the markets? I'll check and see which of these categories have really contributed to this big drop.
Thanks, Mike. The first thing I did was actually look at the estimates coming into the number and the range, and just a shout out to Mike Ferroli of JP Morgan, Tom, and the control group. He was looking for -3. That's what we got. But when you look at the range from positive 0.9 all the way down to -3, the price action, we were softer on the equities coming into this. We're down 0.7 on the Nasdaq, down 0.6 on the S&P. Yields are essentially where they were, 171 coming in a bit on 10s and well off the highs of the session, on 2s off the highs of the session as well, but just above 90. My takeaway, Tom, though, every single time we get this data point, whether it's retail sales, whether it's payrolls, we have these huge fat ranges of economist estimates, and we still struggle to land the number. Well, JP Morgan's Mike Ferrari did that this morning in a big way.
It's 70% of the economy, and John, as you were talking, we got the revision in, which is a little light as well. Let's cut to the chase here. We can do this with Michael McKee. Mike, did we just go from 4 to 3 rate cuts? I mean, rate increases?
It's very possible. We'd have to see how
we have
to see how this plays out.
Come on, are we going to see? These are big numbers. Are we going to see a Fed adjustment off of this?
Not off of this. Chris Waller said last night we have to see how inflation does until we get to the second half of the year. But I mean, these numbers are no doubt terrible, because not only did they drop in December, but November sales were revised down to a 0.2 rise, and the control group revised down to -5. So control is down 3.5% over the last
Lisa, I love busting Mike McKee's chops.
Well, but actually, I'll take you up on that, Tom, because you say, does this actually take a rate hike off the table? I'll take the other side of that, Mike. I mean, does this actually perhaps make the Fed want to move sooner if this is evidence that perhaps some of the high prices are crimping demand from consumers that still, by all accounts, have plenty of cash?
Well, that's a good question. The sooner is, they're not going to do it, as they said before, the end of tapering, which is in March. So I don't know that they do it sooner. Do they do it stronger? We'll have to see if inflation keeps up over the next month or so until they get to that March meeting. But certainly, whether it's inflation or whether it's just being tired of spending or whether it's pulled forward, almost every single category is down. And here's the really surprising one. Non-store retailers, this would be the stuff you're buying off the internet, down by 8.7% on the month, whereas in December 2020 it rose 10.7%. So it's still a tough environment to buy anything. Other really bad groups here: furniture and departments of home furnishings down 5.5%, electronics down 2.9%, food stores down 0.5%, and grocery stores down 0.7%. So we weren't even buying a lot of food then, and clothing and clothing accessories down by 3.1%. And that's interesting because you subtract inflation from that, and these numbers would even be worse.
Mike McKee, thank you, sir. Pretty dreadful number compared to what we were expecting, but I think a lot of people would say you'd have to be very brave to extrapolate out this performance through the next 12 months. Yes. Every single Fed official you speak to right now is looking for some near-term weakness. They're looking for that near-term weakness. What they're also expecting is inflation to average 7% perhaps through Q1. Then maybe peak at the end of March and then perhaps decelerate through the year ahead. And Tom, for the year ahead, they're still expecting a decent year of real GDP growth. I think we expected weakness to end the year because of Omicron. We expect some weakness to start the year. And maybe in some ways, Delta Airlines captured this story ahead of time almost perfectly. They're expecting a rough January, tough February, but a very profitable 2022. And I'm sure for a lot of policymakers right now, Tom, it's going to take much, much more of this on this screen to change their view that 22 isn't going to be a good year.
We get perspective now from Dana Peterson, Chief Economist at the Conference Board. This is an important conversation with the Conference Board's heritage of looking at the American consumer. Go beneath the headline data, Dana. What is the American consumer telling you?
Well, I think the American consumer is telling us that December was a really rough month. But let's think about this. When we look at October sales, they were really strong. So lots of people probably accelerated their holiday shopping. In fact, I went and bought all my toys in October. But we also had empty shelves. And let's not forget Omicron was a huge issue during December. And many people probably were just not out there shopping because they were afraid of getting sick, or they were getting sick, in fact. And indeed, we wouldn't be surprised if consumer confidence in January comes off from what we saw in December. But again, that's a big function of Omicron.
Dana, the first point that you made, empty shelves, how much is this a supply chain disruption story and frankly, supply story if there wasn't the inventory to sell?
Well, I think it all factors in. If there's no inventory, you can't clearly buy anything. And so we really need to watch metrics that tell us what's going on with inventories. And certainly when we look at other private measures, we did see some improvement in terms of the movement of goods. But again, Omicron is a big issue. Certainly in foreign goods that we're importing are challenged by zero COVID policies abroad. And then also even just getting things to shelves, we still have this huge backlog of ships, tanker ships with things that can't be unloaded. And even once they're unloaded, we can't get it to the stores because truckers are in short supply.
One Bloomberg viewer writes in and says, have 4 kids. Santa had a rough time finding things. So talking about how Santa is pursuing.
I used that excuse too, Lisa.
Oh, yeah, exactly.
Going back to the UK when I got over there. The same thing I said. Supply chains are tough. I didn't shop online. I was too scared to go in store.
Sorry. Well, I'm sure that will read really well across the family and baby Charlie. But there is an issue with if December was bad because of Omicron, we haven't even peaked in the United States yet when it comes to the virus. How bad is January going to be?
Well, certainly we could see some poor numbers in January. And at the Conference Board, we've already factored in a pretty weak first quarter, looking at 2.2% growth, which is pretty similar to what we saw in the third quarter with the Delta variant. But, we're coming off of a very strong quarter in general. Fourth quarter probably looked pretty good. We're going to see a sad first quarter this year, but then the second quarter should pick up as we get beyond Omicron, and certainly as in-person services reopen and people can go out there and enjoy their lives.
Dana, World Health Organization has Omicron starting in South Africa and to go north to Botswana. On November 14th of 2021, you guys own the high ground on this. Does the Conference Board see like charge card dynamics and entry dynamics into stores that really changed in December? Is there actual granular evidence of what we all felt?
Well, we don't actually track that data, but I think that, certainly the retail sales are reflecting what happened on the ground, again, for the reasons that we've all been discussing. And, the good news, though, is that in December, consumers were still kind of optimistic in terms of the future. They were still thinking that they're going to go on vacation within the next 6 months. They're looking to buy cars, appliances, clothing, all that great stuff. And certainly, as Lisa mentioned earlier, consumers have the capacity to spend. Many people are working. People still have savings from the stimulus checks. Household balance sheets are in good shape. And so once we get past the Omicron issue, which may be short-lived, certainly as we saw in South Africa, came in strong and then faded pretty quickly, we should probably get back to an environment where consumers feel comfortable spending.
Dana, thank you, as always, to respond to that big downside surprise on retail sales. Dana Peterson of the Conference Board. And Tom, to your question, it was the MasterCard spending pulse data shortly after Christmas, I think the day after Christmas, which indicated that the Christmas spend was pretty decent. And that's why I think a lot of people may be surprised by this even more so if you've been along Macy's and Nordstrom, those two stocks, those two names, trading lower off the back of this number, Tom.
I mean, John, I guess we all fall back on our experience right now. My experience in the island of Manhattan is nobody's on the streets, but, that's not America. And Paul Sweeney was really pushing against that. With Bloomberg Surveillance 9 a.m. And John, I'm sorry, it's a mixed story. And you know what? You were right earlier. You need more data.
We need way more data. And I think for the Federal Reserve, Lisa, it's going to have to get a whole lot worse than this for them to change their path right now with inflation where it is and they're ready to go at the end of March. They need a whole lot more data than this.
How much does this actually play into the story of the Omicron disruptions leading the Fed to move faster? That some of these disruptions that lead to higher prices are crimping demand, and that's not what the Federal Reserve wants to see in order to keep the economy on track. I mean, this story is so nuanced. Did people perhaps rejigger which purchases they were going to make based on which seemed most overpriced to them? I mean, there's so many granular aspects that feed into this.
To be fair, just in terms of the direction, not the magnitude of the move, in terms of the direction, a lot of economists came on this program the back end of last year and said we've had to front load a lot of the Christmas spend. They were anticipating some weakness. Didn't show up in the estimates in a big way, to be fair.
Yeah.
But the direction of travel, they expected some softness to turn out the year, to end the year and start this one.
One terminal client wrote in and said, just to point out that it's nearly up 17% year over year if you take a look at the sales. So it's not like things are going so terribly if you look at the big picture.
Lisa Bramage, Tom Keene, Jonathan Ferro. We're down 0.7 on the S&P. Yields are higher by a single basis point at 172. Earnings season begins with JP Morgan, Wells Fargo and Citi. And after a long weekend into next week, we get Morgan Stanley, Bank of America, Goldman Sachs, and all the rest. You enjoy your long weekend on Bloomberg TV at the top of the hour. Mike Wilson and Morgan Stanley on this equity market. And TK, I'll see you soon. Very soon. Very soon. It's going to be okay. 3 days apart. It'll be all right. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. For a second time, Australia has cancelled the visa of Novak Djokovic. Immigration Minister Alex Hawke overrode a court ruling that temporarily prevented the government from deporting the unvaccinated tennis star. Hawke said it was in the public interest to do so. Djokovic's lawyers were back in court hours later, and there may be a hearing Sunday. The U.S. Supreme Court may have rejected President Biden's mandate for COVID vaccinations or testing, but businesses threatened by Omicron spread might not be forced to implement one anyway. That's so they can protect their workers and keep factories open. The court's ruling still lets businesses require vaccinations. North Korea appears to have fired 2 short-range ballistic missiles. The launch came hours after Kim Jong-un's regime warned it would take stronger and certain action after the U.S. imposed more sanctions. Earlier this month, North Korea conducted 2 separate launches of a new hypersonic missile system. And in the UK, Prime Minister Boris Johnson's office has apologized to Queen Elizabeth II after revelations of partying in Downing Street the night before her husband's funeral. That adds to a string of events that allegedly broke COVID lockdown rules. Meanwhile, the Times of London says a probe into the Downing Street allegations is likely to conclude there was no criminality. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
EVs coming to market. And I'm wondering,
do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share will expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Next week, we'll announce how we are making high-quality masks available to the American people for free. I know we all wish that we could finally be done with wearing masks. I get it, but they're a really important tool to stop the spread.
The President of the United States on something the left, the center, and the right can agree on is we have a pandemic. He's going to have an eventful reset this weekend based on Anne-Marie Horton, based on what Emily Wilkins told us this morning, and we'll see where the president sits. With the Sunday talk shows, you can hear those on Bloomberg Radio and also, of course, into Monday morning as well. Maybe by Monday morning, we'll see a change in the metric of hospitalizations, of deaths of this horrific pandemic. They ebb up a little bit here, edge up a little bit, I should say. We get a weekend brief from Andrew Pekos. He's professor of virologist and therapist for the Keene Dining Room Table. Joins us today from Johns Hopkins and the Bloomberg School there. Andy, this came up last night at the table. What's after Omicron? What is after this variant?
Well, it's hard to predict exactly what's going to happen with these variants. We can say with pretty good certainty that there will be more variants coming down the pipeline, but we really think that, Omicron was a tremendous challenge to the current vaccines and the treatment regimens. And if we can handle Omicron, which in many ways when it comes to hospitalizations and the rates of hospitalizations we probably are going to be in a good place to be able to deal with other surges and be able to limit them in the future.
Where did Delta go?
Delta is still around a little bit. We have a few people here in the hospital that are infected with Delta. Delta is at very low levels across the country, maybe 10% of sequences. But Omicron has really come in and outpaced Delta and really become the dominant virus in an incredibly fast period of time.
Andy, we're talking about economic momentum in the face of the Omicron upswing, and we've been talking about when we can expect it to be over. I'm curious about what you've observed about a 5-day isolation period as the CDC guidance lays out, as well as now the United Kingdom. Is that proven to be the effective amount of time that people are contagious, after which they can go back into circulation?
The problem is it's a very nuanced question. There is some data suggesting that if you've been vaccinated, that after 5 days, you are very unlikely to be infectious, but all of that data was generated with variants other than Omicron. And we already know from some of the testing procedures, some of the transmission of Omicron, that it's doing things a little bit differently than previous variants. So many scientists, including myself, really wanted to hear that 5-day incubation period ended with a negative antigen test, because that would have really been strong evidence that you would be very unlikely to spread the virus if you went back to the workplace.
Andy,
so,
yeah, go ahead.
With other variants, I would have said fine, but with Omicron, things are a little different.
Andy, Tom started the conversation off saying what comes after Omicron, and we're talking about bank earnings. We're talking about the return to work plans that were put on hold as we deal with this latest variant. What will return to work, return to party, return to restaurant look like once we are back to an endemic phase of this virus rather than pandemic?
Well, if there's any bit of a silver lining right now, it's becoming clear that if you've been vaccinated and you get an Omicron infection, your immune response afterwards is not only tremendously high, but it's also very broad, meaning that it recognizes all these previous variants that have come through. So there's suggestive data right now indicating that people who have gotten through this Omicron surge may end up with a really strong immune response afterwards that's going to provide even more protection against whatever the next variant is. And if that's true, that could be a real turning point in terms of dealing with this as a pandemic versus something seasonal like influenza.
Dr. Pecos, thank you so much for joining us today with Johns Hopkins University. Lisa, we've got to go to what you and I were talking about earlier. This is David Blanchflower of Dartmouth College. He's preparing, we need some soccer talk. I told Mike, we need soccer talk every day.
Yeah, exactly.
And Lisa, Blanchflower is preparing for Cardiff versus the Blackburn Rovers. I believe we see that on Saturday. But he's also preparing for an adjustment at the Fed. And he doesn't mince any words about it. He says this is something he saw coming. It is a slowdown. He suggests not the gloom, but that it will stay, let's say, tepid, and that 4 rate rises is not certain.
So he puts out on Twitter to us, all of the mood music based on no data was becoming more hawkish. Now retail sales collapse, as my study of consumer sentiment suggested it would. Issue now is whether anyone has any interest in the actual data. 4 rate hikes, rate rises in 2022, hang on. And this really is the crux of the issue. What data do we look at, Tom? How do we interpret that data? Because right now, I'm seeing some economics notes that are putting this out and cast as that a lot of consumers are concerned about how high the prices are, and that's what's dampening retail sales. That's one way to look at it. The other way to look at it is people aren't going to spend as much. They're getting concerned, and maybe the economy is actually slowing down more than people expected.
To me, it's interesting to see if we get a sequential discussion of rate rises versus what a lot of people in history would say, which is off the bottom. It's okay. The dialogue is we're going to raise rates and then we're going to wait. Like not one and done, but one and wait and see. And maybe that's what next week brings us in the folly of our analysis.
It's an excellent point, Tom.
Did I do okay
Especially,
there?
you did great
Pharaoh
because
would never say that.
long term, this is really the issue that we've heard from one investor after another. What's the long-term rate that the Fed gets to? Where are we going with this, right? And in the beginning, we were going just quickly in the beginning, and then perhaps we wouldn't have as many long-term, and the market was pricing in basically an end Fed funds rate that that looked similar to what we've seen in the past, whereas now we've seen people like Bill Dudley come out and say, no, it should be 3 or 4%. How much does that get gut checked by a deceleration in some of this economic data?
Crazy day, crazy week. And the time that we've got left, Lisa, we've got to go to what matters. What's the auction calendar look like next week?
Well, we already had the slew of auctions this week, right? We got the 30-year yesterday, we got the 10-year the day before, and the 3-year the day before. What's interesting to me about all of those auctions, since I know you deeply care, and you're not saying this with tongue-in-cheek in any way, shape, or form, and honestly, everybody is so fascinated that instead of soccer talk, we're going to talk about bond auctions. To me, the takeaway was the demand was still there. All of this uncertainty not pushing people away from buying U.S. Treasury yields with rates that are still so well below where inflation is right now.
I got the surveillance quill out to take notes there.
Oh, I'm sure you did. Yeah,
really. We hope that all of you have an eventful and a healthy and restful weekend here as we all battle the plague. Lisa and I thank a great team, particularly, we never talk about it, but human resources at Bloomberg. I'm sorry, Lisa, just killing it.
Yeah.
I'm getting love and kisses phone calls from HR. They called up the other day. I'm like, am I done? Is this how I go?
Yeah, no, you still got the plague. It's got just such a tricky moment.
An important conversation. David Weston with a gentleman from Mississippi with the NAACP, Derek Johnson. Really interesting guy. Look for that in the 12 o'clock hour. Stay with us. Don't forget The Real Yield on later today on television. From television and radio, this is Bloomberg. Good morning.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Retail sales disappoint, equities head south. From New York City this morning, good morning, good morning. Equities down 39, we're down 0.8 on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
From New York, we begin with the big issue, earnings season kicking off.
This is about earnings.
It's earnings, right?
Earnings season.
The earnings season.
You're going to see the fundamental facts in full focus.
Earnings go to be pretty solid.
I think it's going to stay pretty good.
Q4 earnings estimates up over 20% is what we have penciled in. That should be great.
Fundamentally, we think the earnings power are coming through.
How stock prices respond to earning beats and misses, I think that's going to tell us a lot about the market in the coming quarter.
We had a little bit of volatility, as we often do, coming into earnings season when there's uncertainty and there's things to worry about.
The issue is that we're seeing really the end of the easy comps.
The tailwind from continued earnings upgrades, I don't see that big here this year.
Corporate earnings as economic growth is going.
There will be a fork in the road where investors need to decide, are they going to keep adding to risk assets here, or are they going to start to look for more defensive parts of the market?
Joining us now to close out the week, Sarah Hunt of Alpine Woods, Morgan Stanley's Mike Wilson and Mike Schumacher of Wells Fargo. I want to begin with you, Sarah, and talk about earnings season and where your focus is this quarter.
Well, I think, as we've said before, this is going to be a year where you need to have growth and profitable growth. And our focus is really not just on what happened in the fourth quarter, but what companies are expecting for this coming year. And I think, you still see a lot of this pervasive inflation and supply chain issues. Sherwin just came out this morning and said that they were going to have a worse first quarter than expected. I think that this is going to be the story going forward into this year. Is it going to be early in the year that you have trouble and it's get better in the back half, or are people worried about the entire year? So I think the focus is on what they see in the future.
They're worried about that retail sales print right now from 31 minutes ago. Mike Wilson, you said this: the real determinant of how long and deep this correction lasts will be growth. More specifically, we are laser focused on PMIs and earnings revisions, both of which are heading lower in our view. Mike Wilson, why is that your view?
Well, good morning, John. Yeah, I mean, that's been our view. As you know, the fire and ice narrative, the fire part now, people understand that's obviously inflation, and the Fed is reacting to that. And that's obviously why the high multiple stocks have really taken it on the chin. But now we have to think about, okay, well, how much of a deceleration in growth are we going to get? The rate of change is what always matters. And, as you and I have discussed over the last 6 or 7 months, the rate of change peaked really last spring or early summer, and it's been decelerating since then. And, our view is just that it's going to decelerate more than what is penciled in. And, look, the reality is that we went through a period of incredible over-earning, right? That was the call coming out of the pandemic, is that we were going to have this incredible operating leverage. And so it would be intellectually dishonest to not understand that you're going to have some negative operating leverage as these costs get layered in. So it's not the end of the world. It's not a recession by any stretch. But the deceleration is just going to be greater than what people are expecting. So PMIs are pretty easy to predict because it's an oscillating index and it's a mean reverts, and that is heading back towards 50. And so that's number one. Number two, revision breadth has been rolling over. One of the things people have been talking about is the derating that's been going on in some of these software stocks and some of the high quality, high multiple names. Well, the reality is that the revision breadth for that group has been turning down sharply since the end of October. So that's the part of the story I don't think is appreciated. We think it will bottom sometime in the spring. But between here and there, we've got some work to do, John.
Mike, why do you think the software story is not just an outlier? Why do you think that's a leading indicator?
Well, because, it is the highest quality part of, sort of the equity market. And then these are tremendous business models. And this fits with our other thesis, John, as you know, which is that we just think there was a giant pull forward of demand post the pandemic. And a lot of that's in the consumer area, consumer goods in particular. Services maybe is a different story. But, technology spending, that's also top on the list of things that were pulled forward. And that doesn't mean that these, the technology spending isn't in a secular uptrend. It is, but it's still cyclical, and there will be payback in demand in a lot of these areas.
That's the software story, and a lot more broader than that as well. We've got to talk about the banks and that sector, that industry reporting this morning with JP Morgan, Wells Fargo, Citi, all releasing quarterly results with the numbers. Here's Sonali Basak.
Yeah, John, there's some real realities that are so
Connection
for
lost.
investors. One of those being higher expenses. As these banks look for a more normal environment, JP Morgan is really setting the tone here on what that means. More technology spend, more marketing spend, and most importantly, higher inflation leading to bigger labor costs, partially due to attrition, partially due to competition, and the expectation that those costs could spread into other line items at the bank. Now, if you look at the top line, if you look at revenue, you're already seeing challenging comparisons when it comes to Citigroup and JP Morgan when it comes to fixed income trading, both falling shy of expectations when it comes to Wall Street expectations. Citigroup also falling short in equities trading. So what does a more normal trading environment look like? At the end of the day, JP Morgan is guiding that 17% return on tangible equity is a more normal environment, and that is less than what investors have gotten the last several quarters. Now, can they get used to that as they expect JP Morgan to compete and spend, or are they going to be finicky as they contend with lower margins ahead?
Sonali, thank you. JP Morgan right now down by almost 5%. A big start to the year for these banks. Sonali's going to run you through the call a little bit later around the opening bell. Sarah Hunt, when I look at the financials in the banks, I said a few times earlier this morning, it captures the stories of the moment. Rates are going up. Look at the performance of banks year to date. The health of the economy has improved. Look at the reserve release. But compensation, things are getting more expensive to hire people, to retain people, to keep people. Sarah, margins held up last year. It was a big story of the performance of this equity market. Can these companies repeat the act in 22?
I think what you're seeing in the discussion about costs right now is it's going to be very difficult. And for some companies, they're not going to be able to. I mean, right now, we're talking about wage increases at fairly high levels. But if you filter this down through everybody and other parts of the economy, the industrial economy and everywhere else, there's shortages in things like welders and things that we need. So I think that you're going to see that wage increase come through, and that is going to be tough on margins. Since everybody's spent the last several years, trying to get other costs down, whether or not they can continue to move other costs down as labor costs move up is going to be a big question about how we get through the margin situation through this year and even, going forward.
Mike Schumacher, to bring you in, and thank you for your patience. This was the fear coming into 22. It's early days to have an outlook with any conviction around what I'm about to say, but a lot of people were worried that this Federal Reserve would pivot to hiking interest rates just as this economy started to soften, started to weaken. Mike Schumacher, what's your outlook look like with that in mind?
John, it's been a great party, but the central bankers are taking away the punch bowl. And I think the big concern there is inflation is still incredibly high. I'm sure all your viewers recognize that. They can look at the stats, they can go through their day-to-day life. But the big worry for whether it's the Fed or central bankers elsewhere is that inflation is a lot more persistent than they had thought. So that translates into a bunch of hikes. Now, I'm really surprised at the speed with which the Fed has talked about and pivoted, frankly, from being very, very calm about inflation, probably complacent, to being of the mind, hey, we've got to fight this right now. But that seems to be the sense we're getting pretty clearly from Powell and from Brainerd. My goodness, if Lael Brainerd talks about getting a lot more concerned about inflation, you know that the odds have really flipped quite a bit. So we do think a number of rate hikes are on tap pretty quickly. It's going to be very tough for markets to digest.
Mike Schumacher, though, you're pushing this further than some people are right now. You think Fed funds finishes well above 2. You've got a 2-year at 160, mid-year right now around 90 basis points. Why are you that much more bullish on where you think this can head?
Yeah, it's interesting, John. We haven't had a combination of incredibly easy monetary policy and incredibly high inflation for 30 plus years in the U.S. So it's nice to be able to trot out the last 2, 3, 4 tightening cycles and say, well, that happened then, therefore it'll happen again this time around. I think that's probably a fallacy. So the real issue here is that very few people, I would say, whether it's across the street or in investment seats or at a policymaker level, have a lot of confidence in their inflation view. And they've got to be really concerned looking ahead. So don't focus so much on inflation now, but think about the end of the year. The run rate for CPI or core PCE, which the Fed cares about, they could both be well above 3%. Unemployment's already below 4%. What if it drops down to 3.5%? Not a very aggressive call. The Fed could be in an incredibly tough spot. That's why we think it wants to take out essentially insurance against that inflation spiral by hiking a number of times. And that's why we think it's going to be a pretty rough ride over the next 4 to 5 months.
And the taper will be complete by the end of March. The balance sheet reduction could begin in the next several months after that. Mike Wilson, you've made this point in your recent research, and I have to say, when I was reading through it, it was a fantastic read. This is not 2013. It's different. Can you walk me through the big differences right now for this equity market?
Yeah, so we don't have a lot of experience in tapering of asset purchases. Obviously, we have an example of one in 2013, but it is very different from that episode, John, as I wrote about. And there's three main things. The first is that in 2013, the pace of the tapering was much, much slower, right? So they basically planned to exit QE in about 10 months. This time they're doing it in 4 months, and it's a bigger, policy initiative. So that's a lot of removal of accommodation. Number two, valuations were much, much lower in 2013. We were trading at 14 times forward earnings. Today we're at 21 times. And the equity risk premium is about 300 basis points. Back then it was 500. So you had a lot more room to see valuations actually go up. At the time, in 2013, we were very bullish on the tapering because it was a sign that we were actually getting out of secular stagnation. This time around, it's very different because we've got more inflation than we ever dreamed of, whereas back then we were just starting to come off of this sort of financial repression area. That was very positive for equity valuations, given where their starting point was. The last one, which is probably the most important distinguishing feature, is that growth is decelerating now. Growth was accelerating sharply in 2013-14, and we measured that through the PMIs and through revision breadth. So it's just very, very different. We'll get through this. It's not the end of the world. But the idea that you should compare this to 2013-14, I think, is misplaced.
Mike Wilson, Mike Schumacher, Sarah Hunt, sticking with us. Looking at this market at the moment, we're down 3/4 on the S&P, down 0.8 on the NASDAQ, with some movers ahead of the opening bell. Here's Katie.
Well, John, I really want to focus on JP Morgan because that stock now down more than 4%, actually about 4.5% on the back of its earnings. Investors not focusing on that beat on EPS or on investment banking revenue with advisory fees up 86%. Instead, it's more the negatives, like that bigger than expected slump in trading revenue, FIC down 16%, and a 10% jump in expenses, which Sonali was talking about, part of that higher compensation, and then loan growth. That is really still quite muted. So remember, JP Morgan was up about 6% year to date coming into this print. We're giving back a huge chunk of that this morning. And if these losses hold through the close, this could be the worst day for the stock since June of 2020 and the biggest drop post earnings in more than a decade, going all the way back to the third quarter of 2011, John.
Katie, thank you. Big performance coming into today, just a little bit of weakness coming off the back of the numbers. Coming up, President Biden lining up his Fed picks as a growing chorus of policymakers call for rate hikes.
Prices have been uncomfortably high, rising at uncomfortably high rates for some time. That's not price stability, and I think every American knows it and feels it, but also the Fed knows it and feels it.
More on that conversation up next from New York. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Season is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal.
Where are investors seeing the weaknesses?
It means profits down the line.
Earnings season on Bloomberg Television and Radio.
I definitely see rate increases come.
3 hikes is still a good baseline.
Inflation is too high, and working people around the country are concerned about how far their paychecks will go.
We will have to wait and see what inflation looks like in the second half of the year.
Our monetary policy is focused on getting inflation back down to 2% while sustaining a recovery that includes everyone. This is our most important task.
If it continues to be high, the case will be made for 4, maybe 5 hikes.
I tell you what, I know it's not just me. I know for a lot of you at home, it has been non-stop with the Fed speak this week. A busy week for the Fed. This is President Biden prepares to fill key vacancies, expected to nominate Sarah Bloom Raskin, Lisa Cook, Philip Jefferson to the Federal Reserve Board. Republican Senator Pat Toomey pushing back against Raskin's nomination, writing in a statement the following: I have serious concerns that she would abuse the Fed's narrow statutory mandates on monetary policy and banking supervision to have the central bank actively engaged in capital allocation. With more on these picks, here's Mike McKee. Morning, Mike.
Good morning, John. Well, they finally came. Vladimir Estragon and Godot show up, the 3 names we've been waiting months to get. As you mentioned, Sarah Bloom Raskin, who is a former bank regulator, deputy Treasury Secretary, and Fed governor. Lisa Cook, who is a professor of economics at Michigan State University, no stranger to the Fed, a regular at Jackson Hole. She would be the first black woman ever appointed to the board. And Philip Jefferson, a longtime academic, done a lot of work on incomes and inequality. He'd be the 4th black man ever named to the board. And by the way, if they're all confirmed, the Fed board will have a majority of women for the first time. You mentioned the controversy with Raskin. She's been outspoken on the climate change aspects of the Fed, and she stirred up some trouble last year when she suggested that the Fed should not be buying the bonds when it was buying bonds of companies, of fossil fuel companies, because they're a lousy investment and they pollute. And that brought that statement from Pat Toomey, but it does suggest that Toomey and other Republicans on the banking committee are going to put pressure on her. The other question is how long before they join the board? I wouldn't expect them, maybe not even in 2022, given it's an election year. You can see the last 3 governors, it took almost a year for each of them to get confirmed from the time they were nominated. So they're really, if you're trying to figure out what they mean to the Fed, they're really a 2023 edition.
Mike McKee, those 3 picks, they are official. That statement just coming out from the White House, just as you complete your thoughts. Thank you very much for that, sir. Mike McKee on some of the picks over at the Federal Reserve. The data, industrial production coming in a little bit lighter than expected, falling 0.1% month over month. The estimate positive 0.2. That's the economic data. Hearing a lot from Jamie Dimon at JP Morgan this morning. He's expecting more interest rate increases than implied by the curve right now. Going to pick up on that with Mike Schumacher in just a moment. A lot of this is about confidence in the Federal Reserve. We caught up with Richard Bernstein of RB Advisors, warning that investors could start to lose confidence in this Fed. Take a listen.
The surprise comes from people begin to realize how far behind the curve the Fed actually is. I think it's important to remember the Fed is, with the exception of the Volcker Fed, the Fed has always been a lagging indicator. The Fed is way behind the curve. You know, people are asking, have they made a policy mistake? 7% inflation seems like a massive policy mistake to me. It's already been done. I think people are going to lose faith in the Fed as we go through the year.
Mike Schumacher, those words there, they resonate with you, don't they?
They do indeed. Yeah, 7% inflation, 0% Fed funds. That's not really a very good balance. So the Fed's far behind. I agree with that point. And we think it's well past time for the Fed to start tightening, whether it's on the balance sheet side or with rate hikes. So definitely resonate, John.
Mike Schumacher, it doesn't sound hawkish to me. We keep using this phrase hawkish. The Fed has turned hawkish. I think it's worth remembering that historically, this is probably one of the most dovish central banks in history to have headline inflation at 7 and the Fed funds rate at 0. And before we forget, they are still buying bonds right now. Net purchases are happening right now. They continue into the end of March. With that in mind, Mike, do you think the pivot is actually complete?
No, the pivot's not complete. I think it's been an incredible flurry of news over the last month or so, John, but you make an excellent point. The Fed is still super accommodative. And one really good measure of that is real yields on long-term bonds. For the 10-year Treasury, roughly negative 75 basis points. Yes, that's negative. That's very unusual in the U.S. I know it's been negative for a long time, but even if that were to go from minus 75 to negative 50, it's still deeply in negative territory and incredibly accommodative. So hawkish is not the right term.
Mike
less
Wilson.
Accommodative, less lax, but not hawkish.
Mike Wilson, I want to get your thoughts on this off the back of what Mike Schumacher just said as well, because a key part of your call into 22 is on multiples and the reasons behind why multiples will have to come in. Can you build on some of that, Mike?
Yeah, I mean, I think that clearly the Fed has been ultra accommodative, and, you know, we started to change our view on that back in this summer. I mean, it was clear that inflation was moving even faster than we expected, and we've expected inflation to surprise on the upside. So here we are, and now we just have the other side of the mountain. It's not really that complicated. I mean, the math is the math, right? Rates are going up. We have a target of 230 now on the 10-year by the end of this year. If you use an equity risk premium of 350, which is historically still, you know, quite low, particularly in an era where you're exiting financial repression, where, you know, rates are going to be even higher in the future, 350 seems conservative. I mean, that combination right there, John, is 17 and a half times earnings. We're at 21 times. So look, the de-rating process has already begun, okay? It's clear as a bell that the market is, you know, taking down the multiples of, you know, the most expensive stocks, but the overall index is still expensive because we've had incredible inflows to the market. There is no other choice, supposedly. Well, there is a choice. You don't have to chase high asset prices, okay? And we think that that will happen this year. We think that the flows will slow, and that's what's going to lead to ultimately the de-rating at the index level. It's already happened at the stock level to some degree, but now it has to happen at the index level. And we'll get through this, okay? Because earnings aren't going to go negative. Earnings are just going to decelerate, and it's just not going to be as, you know, glorious as it was for the last 18 months.
Sarah Hunt, I wanted to give you the final word on that. Why at the index level we could see some de-rating, and that de-rating could well continue.
Well, if you look at some of the stocks that have been the outperformers, some of them, you know, something like Tesla has a rating and a multiple that isn't really market related at all. And some of the larger stocks that have driven some of the performance of the indexes themselves haven't derated as much as the stocks underneath. And if you look at a lot of those individual stocks underneath, you've seen a lot of bad performance over the last 6 months. So it's clearly that the top of the indices have had continued momentum as money has continued to flow into this. I don't disagree that you're going to see some issues with that, and I don't disagree that multiples are going to have a very hard time in a world where you are moving from an accommodative Fed to a less accommodative Fed, and we're not quite there yet, but we're getting there.
We'll continue this conversation going into the opening bell. Sarah Hunt, Mike Schumacher, Mike Wilson, your equity market down 0.7% on the S&P. We're down 34. Up next, the morning calls, and later, the big banks unofficially kicking off earnings season. Breaking down the results with Baird's senior research analyst David George. From New York this morning, good morning. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
From New York City.
Here in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
have a great evening.
To recap the headlines.
You do not want to miss this
How are
story.
you thinking about those dynamics?
Five minutes away from the opening bell, retail sales disappoint, a downside surprise, and we go lower on the S&P. We're down 0.7% on the Russell, down 8 on the Nasdaq 100, down 0.7% as well. Retail sales behind us, some bank earnings in the mix as well. In the pre-market, this is what we look like. We're down 4% on JP. Wells Fargo just positive. Big year for Wells Fargo so far. I'll get to that in just a moment. Citigroup down 3%. Year to date into today. It's worth considering this. Look at this for a move. Up 16% and some, almost 17. Thursday at the close on Wells. JP Morgan up 6, Citigroup up 12. This is into today's session. That's the price action. Let's get you some morning calls and kick things off with RBC downgrading 4 to sector perform, $21 price target. The analysts seeing little room for upside following the stock's recent gains. Piper Sandler raising its Apple price target to 200, seeing a favorable macro setup along the continuing iPhone momentum. And Guggenheim downgrading Disney to neutral, expressing fresh concerns about the pace of future earnings growth. That stock is down by 1.8%. Coming up, the big banks taking center stage. Why Baird's David George doesn't want to chase these names. That conversation just around a corner. Your opening bell is next from New York. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think that we've seen
seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the opening bell here this morning. Good morning to you all. This Friday morning, we are heading towards a...
Okay, hello traders. How are you doing today? I placed an order to sell a position on British pound. It's the order placed at, I will place at 137.02. Just right here. It will give us £1,000 in profit. As you can see, we hold two positions, and one position I am looking to sell. Position we hold you can find from our ticker at 138.02 and 136.227. Okay, I'm going to sell these two positions if it will reach 137.02. And it will give us £1,000 in profit. So how it works? Basically, you will have to calculate, you will have to add 138.2 plus 136.227 and divide by 2. The price, 137.122 as far as I remember, will be the price if the price will reach this level. It means, and if I decide to sell these two positions, I will make no money at all. It's like the lower position was hedged at the level 138.02. So I'm placing an order to sell at 137.02. 1 pip equals £100. In this case, it will go to 10 pips. So it will make us a profit £1,000. Okay, guys? Stay safe. I'll speak to you later, and let's see what's going to happen next.
Contend with.
Give us the look forward, the look through. Go through these numbers and give me the look through to next week.
This is the issue. The trading environment normalizing and the fact that none of the executives have true answers for what it looks like is concerning, because what that creates is a lot of variability in an industry that a lot of people were hoping would be a lot more predictable this year. And as we know, Goldman Sachs and Morgan Stanley have two of the biggest trading divisions here, and the answer from them on what that looks like this year will be pivotal.
Shanali, thank you. Let's see if Goldman can get that execution up again, given what we saw through much of last year. That stock on JP Morgan right now is down 5.8%. The financials, worst performing industry group on my screen, down 1.8%. Baird weighing in on this morning's bank results, writing the following. We acknowledge the EPS benefit and leverage the higher rates most banks have, but it's getting priced in and then some. We aren't inclined to chase these stocks from here. You wrote that, David, going into these notes, and David George joins us right now. Going into these earnings, they were your thoughts. And David, I just wonder, with what you're seeing this morning, whether it makes a lot of sense.
It does. You know, these numbers this morning, Jonathan, have been fine and have been good, really. There's been very encouraging loan growth trends. Deposit growth continues to be very good. And credit quality is also quite good. But this is, I think, a situation, Jonathan, of just very high expectations going into these reports. Financials have become a very consensus trade so far in 2022, and you know, there's a price for everything. And while we feel good about the companies and their respective outlooks, the stocks are reflecting quite a bit going into these earnings reports.
David, can I just pick up on the expense line as well that came up in places like JP Morgan, places like BlackRock as well? Do you get the sense that's the start of something? For me and for many others, this is the first time in a long, long time that we're not talking about job cuts. We're not talking about people cutting costs. We're talking about them going the other way. That seems significant to me.
Yeah, I think we as financial services investors, Jonathan, have become accustomed to fairly limited and fairly subdued expense growth over the last several years. And that comes from cutting branches and just not really seeing meaningful wage increases on the part of their human resources. But I think we're in an environment for talent today where banks, financial services companies have to compete with technology companies for talent. And in addition to having to pay people more, there's a need to invest in technology and cyber and products and services that is kind of a double whammy that is driving expense growth higher. And this is not something that's really significant, but that rate of change, Jonathan, this year versus last year is certainly of note, as you mentioned.
The missing piece for a lot of people is the loan growth. David, any signs that that's turning around for you into 22?
Yeah, it is. I think one of the more encouraging things we saw this morning from J.P. Morgan and Wells Fargo is there is some signs of loan growth. It was roughly 3% at J.P. Morgan and almost 4% at Wells Fargo. And as the supply chain issues start to resolve themselves, you should see a pickup in commercial loan demand, commercial line of credit utilization. If companies don't have inventory to sell, there's really no need for them to borrow. But as that changes, I think that's certainly a positive as we go through the new year.
David, final word just before you have to run, because I know you've got a really, really tight schedule this morning with all the banks releasing earnings into next week. Have you got a decent view now on what the rest are going to look like?
Well, these companies today are very capital market centric, but I do think that the biggest theme in thinking about next week is in terms of thinking about 2022. This expense headwind is something that I think investors may be underestimating a bit. If J.P. Morgan is going to invest, and they're the behemoth, they're essentially the Amazon of banking from my perspective. If J.P. Morgan's going to invest, they're going to raise the bar for everyone else. So I think that's something to think about for the regional banks that compete with J.P. Morgan. If JP's going to invest, it's going to force others to do the same.
David George, thank you, sir. As always, buddy, great to catch up with you from Robert Baird. J.P. Morgan down by almost 6% right now. Your broader market on the S&P down about 0.5%. The Nasdaq down 0.2%. For the year so far, it's been rising rates supporting the big banks. That's been the story. But that story has also been weighing on big tech. The Nasdaq 100 falling 5% in 22. The worst start to the year, going all the way back to 2008. Looking at this is Bloomberg's Katie Lyons. Hey, Kaylee.
Hey, John. Well, we've been talking about this growth to value rotation for some time. It seems the calls are always there, and yet it very rarely seems to stick. So far in 2022, though, it is sticking. If you take a look at it this way, the S&P 500 market-weighted index, where big tech like Apple and Microsoft has an outsized influence, is down nearly 3% so far this year. When you reverse the weighting, so those big tech players have the least amount of influence, we're in positive territory by about 0.2%. And just from a value versus growth perspective, the S&P Value Index is up by about 0.5%, while its growth counterpart is down nearly 6 full percentage points. It really comes down to the rates equation, as you mentioned, John. Higher rates put pressure on stocks with higher multiples because it means their future profits aren't worth as much right now. And that forward PE multiple on growth is significantly higher. That index trades at about 26.5 times forward earnings, while value trades at a much lower 17.5. So it comes down to one question. Is this finally going to be the year where it pays off to be cheap? I say finally because that hasn't been the case for years now. When you look at the ratio of that S&P Value Index relative to the growth one, it has risen sharply so far in 2022, but looking on a longer-term horizon, that barely makes a dent. Value has a lot of catching up to do relative to growth, John.
Kelly, thank you. Thank you very much. Still with us, Sarah Hunt, Mike Wilson, Mike Schumacher. Sarah Hunt, I want to come to you and put together some of the pieces of the last 40 minutes or so. To what degree, to what extent, is rate exposure really important to you right now to get that exposure in places like the financials in U.S. banks?
Well, we had already had a position in the financials last year because we thought that this was coming, and also because the banks looked really inexpensive relative to the rest of the market. I think that the rate exposure, it's going to be interesting to see what happens to the curve itself as the Fed starts to move, because right now that hasn't been enormously helpful because you haven't seen it steepening, you've actually seen it flattening. So I think that it's going to be about, this comes back to, are you getting growth and is it profitable growth? And can I look at that and say, where is the place where I can get some earnings out of this, but it's not earnings one at an already elevated multiple, but I still have some growth. And that's the tricky bit about value, because a lot of the value stocks don't have a lot of growth. And that still is going to be important going forward, but it has to be something where there's some sort of fundamental underpinning, which we haven't had to talk about in the last couple of years.
Mike Wilson, away from the index, where do you want to be?
I mean, we've definitely skewed more. I mean, we've made the switch to quality back in April, May of last year, and that was really a large cap growth call. And then we pivoted again in November to more defensive quality because of the view that we have that growth is going to now disappoint. So large cap defensives, and then we want to barbell that with small cap value, because as you point out a minute ago, while value at the large cap has really not outperformed growth much in the last 6 months, small mid cap value has dramatically outperformed small mid cap growth. So that's where the value is. That's where the real opportunity is, we think, in the value cohort.
Mike, when you've back tested this, when you look at what happens when EPS growth peaks and defensive leadership starts to develop, how quickly after that does it start to develop?
Well, I mean, in terms of the fundamentals, I mean, usually it's pretty coincident. So I think the market is really, since mid-November, the defensive rotation has been dramatic. It's something that hasn't really been talked about much. I'm not sure why, but it's happening. And that tells us that we're going to be right about PMIs coming down significantly. So, we would say be overweight, the defensive parts of value, not the cyclical parts of value. I think and we're seeing a little bit in the financials today. The financials may struggle a bit, even though rates are going up, because, that is the cyclical part of value.
Mike Schumacher, that's where I wanted to finish with you as well, sir. Going deeper into the year, the scale of deceleration that we could see in this economy. Mike Wilson is looking at the PMIs coming back down towards 50. Mike Schumacher, is that what you're looking for too?
Yeah, it seems plausible. Probably a decent cutback in terms of growth, John. I think that's pretty likely a case here. And it does get back to that loop between inflation and monetary policy. How persistent is inflation? Therefore, how heavily do the central banks have to hit the brakes? I think that's going to tell the tale for the balance of the year, frankly.
Mike Schumacher, just a final word on that.
Okay, traders, as you can see, position closed on British pound at 137.02. We have 1,000 pounds in profit. Well done, guys. Let's move on. Let's not concentrate on one winning. And I'll keep an eye on euro. So I'll let you know what I'm going to do with euro. I will see where it will go, up or down. Okay, guys, stay safe.
Cycle end up. The market's priced for about 175 right now at the end of 23. We think that's too low.
Yeah.
So if the Fed starts to communicate that, then I think you can get a pretty big backup in the front end. So that's how we eventually get that conversation to work.
Sarah Hunt, Mike Wilson, I'd love to finish with you both on that. Let's just take Mike Schumacher's word for it. He's got the crystal ball. It's 160 on twos mid-year. Sarah, how would this market digest that?
I don't think that would be very well taken by the equity markets. I think that they are not expecting things to move quite that quickly. And the longer term issue for the Fed is also that we've got a much bigger debt load globally and in the U.S. itself. So higher rates start to translate into government spending shifting away from whatever else they want to do into making interest payments. So I think that there's a real tension with that as well. But I don't think that the equity markets would be very calm with that change in the 2-year that quickly.
Mike Wilson, final word.
Yeah, I would agree. I think that would be a curve flattening, and it would fit with our view that the defensive cohorts actually do quite well. So I actually agree with that setup. I think the curve will probably flatten later, middle part of this year, and it's not going to be great for equity valuations.
Mike Wilson, Mike Schumacher, Sarah Hunt, all three of you, thank you guys for working through the opening bout. JP Morgan down and down hard in early trading, about 12, 13 minutes in, down a little more than 5%. Coming up, President Biden approaching 1 full year in office.
The president has had, we feel, we've had a lot of success over the past year getting a bipartisan infrastructure bill passed. And what we want to do now is build on that in year 2.
The latest on spending up next.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
Next week, we'll announce how we are making high-quality masks available to the American people for free. I know we all wish that we could finally be done with wearing masks. I get it, but they're a really important tool to stop the spread, especially of a highly transmittable Omicron variant.
President Biden spotlighting bridge money in the bipartisan infrastructure law. Transportation Secretary Pete Buttigieg writing the following: modernizing America's bridges will help improve safety, support economic growth, and make people's lives better in every part of the country. For more, let's get to AMH down in D.C. Morning, Anne-Marie.
Good morning, John. We're going to hear from the president later today, and he's going to be highlighting where some of that money from the hard infrastructure package, that bill that he signed into law just 60 days ago, he is going to be talking about $5 billion going to repair some bridges and highways across the United States. And John, I have to say, it's an interesting moment to be doing this, right? Because we talked about this earlier, Greg Valliere coming out with really a blistering note about what he is calling the worst week for the president, given everything that has gone on with voting rights, the Supreme Court ruling down on the centerpiece of his vaccine mandates. This is a chance for the president to talk about something that most Americans can agree on, right? Fixing our roads and fixing our bridges.
You mentioned Greg Valliere of AGF. Let me just read out his words, Anne-Marie, for our audience. Joe Biden has stumbled through his worst week as president, stung by the Supreme Court, failing on voting reform, blamed for surging inflation, plunging in the polls. Anne-Marie, has it really been that bad?
It has been a rough week for the president. I mean, last night he was even trying to get through his own party when it comes to voting rights, which is going to likely fail in the Senate, by having over Senator Manchin and Senator Sinema to talk about what they can do and where they're potentially willing to negotiate with the president. And then, of course, yesterday, the Supreme Court, Jonathan, says that his mandate about testing and vaccines for businesses over 100 people, well, that just doesn't go with what is in alliance with what the Congress has given to OSHA in order of what their statutory mandate is. And then many people have also talked about the fact that he might have went a little bit too far. Even members of his own party given his Atlanta speech when it comes to voting rights. So this was a rough week for the president, but he's going to end it talking about something hard infrastructure. If that's enough to potentially cap off on an optimistic tone, we'll have to wait and see.
Well, Senator Warren is happy with his Fed picks. She says the following out of the statement: Raskin is tough and thoughtful, a tough and thoughtful financial regulator. That from Senator Warren just moments ago in a statement. That's Senator Warren of Massachusetts. Here's Senator Toomey of Pennsylvania, Republican. I have serious concerns that she would abuse the Fed's narrow statutory mandates on monetary policy and banking supervision to have the central bank actively engaged in capital allocation. Anne-Marie, you're better positioned than I to give some comments on this. How messy do you think some of these confirmation hearings might be?
I think she's going to be the hardest one, right? So you have Mr. Jefferson, which already we heard from President Trump's former head of economic counsel saying he wants to aggressively help to make sure his nomination goes through. And he would have had 100% confidence telling former President Trump to put Mr. Jefferson on the board. And then you have Lisa Cook, who, Jonathan, at a moment right now in history with inflation, she actually worked helping the Nigerian government in 2005. Nigeria in 2005 was dealing with double-digit inflation, nearly 20%. So these are some people that I think will be able to get through. But when it comes to Sarah Bloom Raskin, it's going to get very political, given her writings on climate change. And what Senator Toomey really takes aim at is the fact that he is worried that she'll push for choking off lending to some traditional fossil fuel companies. But yesterday, Jonathan, Lael Brainard said it, that is not the position of the Fed. So potentially that is something she is going to be able to use during these confirmation hearings. But potentially hers, I think, is going to be the toughest one to get through.
Yeah, Anne-Marie, I really dislike this, but I think we have to be transparent and open and honest about just how things are, the reality of the situation. Do you think, and I hope they get fair, open, honest hearings where people just take them for who they are, what their resume is, what their experience is. But as you know, the husband of Sarah Bloom Raskin is Jamie Raskin, congressman.
Yes.
Do you think that could make this just a little bit more messy for some Republicans who are supporters of the former president when Jamie Raskin, of course, led and helped manage the last impeachment trial?
Well, that's exactly right. He's not just any congressman, right? He is a congressman that helped lead the impeachment trial for the former president. This is another nuance to Sarah Bloom Raskin's confirmation hearings that is going to make it very politicized. Now, yes, Jonathan, you and I, we work in a data-driven world. We like to see people's resumes, like to see what their literature was about and their research about, which all three of them are firm economists and have done work, whether it's the Treasury or the Fed in their prior lives, have gone on to do a number of academic research. But no, this will become politicized because that is what Washington is, especially in this moment.
You hope that's not going to be the case, but as you point out, Anne-Marie, it often is. AMH down in DC. Anne-Marie, great work, as always. Let's get back to these markets. Equities down a little bit at the opening bout, down a lot, then coming back some on the NASDAQ 100. Right now on the S&P, we're down 0.2%. The NASDAQ now positive 0.2. Breaking down a sector price action. Here's Katie Greifeld.
Hey, John, well, there's not too many places to hide this morning. You have 8 of 11 sectors lower at the moment. It looks like energy is your early oasis as oil prices climb. You also have technology fighting its way into the green, higher by about 0.5% after really taking a beating yesterday. Now, at the bottom of the pile, no surprise, financials leading losses in a big way after some of the biggest banks took the stage earlier today. And I know you've been talking about them all morning, but John, if it's not too overkill, let's stick with those banks because that sector, it's really been on a tear over the past year, up about 28%. But as we've learned this week, it looks like the fourth quarter was really a mixed bag. You had trading revenue trail off at JP Morgan, Citi, Jefferies. And looking at the price action this morning, traders aren't feeling too forgiving, John. You have JP Morgan shares plunging by about 5% at the moment. If that holds, that's going to be the worst post-earnings performance in about a decade, John.
Unreal stats. Katie Greifeld, thank you. Both Katie and Kaylee pointing that out. You can find that yourself on a Bloomberg terminal. If you load up JP Morgan and just enter ERN for earnings surprises, look down the right side of the column on the Bloomberg terminal and you'll see those surprises. It's been a long time since we saw a 5% move post-earnings on JP Morgan. That stock is down 5% precisely on my screen at the moment. Jamie Dimon's talking up rate hikes. Expect more interest rate increases than implied in this curve. Coming up, your trading diary from New York. This is Bloomberg. About 25 minutes into the session, let's call it 26. We're unchanged on the S&P now, reversing the move lower on the Nasdaq, positive 0.4%. Story of the morning, though, it's got to be the banks. Go to the banks, up big time year today into today's session, then down some on JP Morgan off the lows, but still negative 4.7%. Wells Fargo having a massive year so far year today. Citigroup a little bit lower, down 2%. For the first time in a long time, we're not talking about job cuts. We're not talking about pay cuts. We're talking about pay rises, hiring, and investment. On Wall Street, it has been a while. That's the price action. Here's your trading diary, what you need to be looking for. You, Mitch, top of the hour. We'll hear from New York Fed President John Williams, 11 Eastern, followed by President Biden discussing his infrastructure plan this afternoon. Looking ahead to next week, a long weekend into China GDP on Monday and more bank earnings. From New York, this is Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick has invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company, and we have an investment in the Jabal Sayid copper mine, one of the lowest cost, highest grade mines around actually, and we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing otherwise. for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter. It's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I am about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwist, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million. Whoa.
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
the GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disrupts